We are happy to see you. We are happy to have another 3 hours together. Be prepared because there will be a lot of useful information. There will be also some new terms for you, but don't worry, take your time after the meeting and reanalyze them. And yeah, we would like to be, as we said at the first workshop, to be an open discussion. So not necessarily at the school or the university. If you have any questions, you can address during the workshop or in the chat as you wish. We do have some Q&A at the end, but in order to be, an informal meeting, feel free to ask whatever you want related to the workshop, of course. But if you wish other terms, other things, we are open as well. Today, we will be discussing about different instruments and different terms that are used in the investment process. Probably you've heard about some of them, but it's always good to read again about them and better understand all the terms. Here is a short disclaimer. We already discussed at the first workshop, so everything that we are presenting in here are information gathered by us from our experience, from different sources. But of course, you need to make your own due diligence to be sure that what you find out today is suitable for what you are building. And then, of course, if you want to use this presentation for other purposes, you'll need our approval as well.
We are not providing any legal advice, although we would be talking about a lot of legal terms. So we are not licensed lawyers. I work for a law firm, but I am a consultant, just putting it out there.
Super. You already know me. You already know Gautam. Okay, so here is the agenda. Because there has been 1 week since the last workshop, we thought that would be to have a short recap. And then we will go through the equity round, option pools, conventional methods, all kind of introductions to different kind of investments. Then some terms, due diligence, legal due diligence, as Gautam already said, and how you should prepare actually the due diligence in order to be ready for having discussions with investors. Great. So as you already know, we've been discussing the first workshop about investors. So yeah, the investors are individuals or organizations, I give a good admit, that allocate financial resources to companies. They are mostly looking for economic outcomes, sometimes for different reasons. And of course, they have a huge role in the economy because they can provide, capital for growth, innovation, and development, and creating the new jobs in the ecosystem. So this is in a nutshell the role of the investors and their definition. And then as we discussed for your stage, again, the most appropriate investors would be angel investors, so individuals that have money and then can allocate few thousands of dollars. Then angel syndicates, accelerators, incubators, and then, as we discussed yesterday, crowdfunding investors, either through money, either through buying your products. In case of Besnik, then you have micro VCs, smaller VC firms that usually invest up to 500K. And then we have VC funds that are usually coming to later stages. So at seed round, Series A, Series B, Series D, etc. Then we have growth funds. But for now, it's enough for you. We also discussed about the investor motivations. Just went through some of them. So financial return. They're looking also for innovation. They want to invest in those companies that are really disruptive and create maybe new markets, new industries. As well, they want to become the key opinion leaders for those companies that can influence the market itself. A short recap about the pitch deck, and I was very happy yesterday to see that you two, Besnik and Gentren, sorry if I mistaken your name, used this kind of structure, introduction, problem, solution, market opportunity, business model, product, technology, competition, traction, team, funding, and vision. As I said, is not the only one structure for a pitch deck, but mostly it contains everything that is important for an investor to take a look and take kind of first decision or first screen of your product. Okay, so I believe that it's really important before starting discussing with investors to understand them, to know their types, to know their ticket sizes, the geographies in which they are investing, what are their motivations. As you know, sometimes, and Gota mentioned yesterday, there is gut feeling. So it's very important from the first discussion that you are having with them to see whether you can create kind of connection, because it will be a kind of a partnership on a long run, 5 to 7 years. since the first discussion that you are having. And then, of course, you need to better understand the key terms that you are, using or discussing or negotiating with them to be very prepared and to take the best decision for you. And also, of course, besides understanding the investors, which is the first step, then you should prepare everything related to the fundraising, to have a good strategy behind it, have all the materials according to the profile of the investors that you're looking for. So this is a nutshell in 5 minutes what we presented in the first workshop. If you have any kind of questions regarding this short recap, now is the time. No, perfect. Gotham, that means that we were excellent, so everything is crystal clear.
Sure.
Great. So now we will go to, thanks, Rinda. Now we'll go to the workshop itself. So now I'll give the floor to Gautam. As I said, there will be a lot of terms in here. If you don't understand something, raise your hand, write into the chat, open your mic and ask, because we are here to teach you to be sure that you really understand everything. Gautam, please.
Sure. Just go to the next slide. So we are starting with an equity round, and most of you know that if you want to raise financing, you want to get money from the investors, you have to give away a certain percentage of your company. So that's where the most common form of raising capital is known as the equity financing or equity round comes into place. So most of the time, companies, when they are raising capital, you are raising the capital to finance your short-term expenses of running the business. So that's why you need some money for marketing, you need some money for operations, you need some money for technology. Now that's the basis of equity round. Now for some companies, and I will say this as a case-by-case basis, and these are companies where they would require money to invest. Let's say any company which has created a tool for, let's say, asset management, or a company which is focused on price arbitration. So these kind of companies often want to raise money where the money will be invested, actually. And that kind of a security is not going to be invested a lot by VC funds or angel investors. And specifically for VC funds, when a VC fund raises money to invest, right, they also sign a term sheet of the fund. That's where there are a section called restricted investments, or investments which the VC fund cannot make. So in that section, usually, if the VC fund intends to give money to a company that will be used for further investment purposes, that is usually not allowed. So I don't think you are any of those companies. You want money to finance your short-term cash expenses. So that's where the equity round comes into play. Okay, you can go to the next slide. So when it comes to the key components, right? So you have authorized share capital, issued share capital, and paid up capital. Now you can read through with it. But at the end of the day, there is, I'm not sure in Albania, Robert, I'm not sure you know, is there a concept of preference, or is the common shares basically they add some preference to it?
Yes, there is.
You have preferred shares?
Yes.
Okay, so that makes it much.
The
Okay.
preferred shares, they get the dividends first, the money
Okay.
first, then the other shares.
Okay. So for all the other people, there are different classes of shares when it comes to issuing shares. So you have common shares, right? And common shares can have some classes within it, depending on the jurisdiction, depending on the voting rights, right? As a founder, you should always have the highest voting rights. Okay, this is again a recommendation which I'm giving. And when it comes to investors, they want preferred stock. They want preferred stock because that helps them safeguard their investments, as they are taking a lot of risk investing in a company so early on. So they need some extra rights, not necessarily with respect to voting. However, when you invest, there is a lead investor who will be taking the lead on your round, meaning setting the terms of the round. And that person would be taking a board seat, depending on how large your company is getting. Okay, so we have some data we'll show you later on, what the board size looks like as a company progresses and so on. So in that way, this preferred stock actually comes with some form of different rights which are curtailed in the term sheet. So these things mostly authorized share capital, issued share capital, and paid up capital. This will go more into the concepts when you want to go for IPO or something. Right now, it's going to be more concerned on you have common shares and you're issuing preferred shares. Okay, you can go to the next slide. So this one again, I think Robert, you can explain this one. This is your slide. You're on mute.
Yeah. Okay. Yeah, so basically here is an example of a company who wants to raise capital from some investor. And in here you have various types of share capital or equity share capital. So basically it's starting from the share capital, and then it might have two options, either preferred, either capital, and of course each of them has other options as well. It's a bit difficult to explain all of them, but you will have the slides at the end of the presentation, and you can go to all of them. Usually, these terms are not very, often used. Depends on the geography. We try to gather in all the information that are used worldwide, but sometimes some of them are not used in our region. Yeah, this is in a nutshell, Gautam.
Okay, so here I would just say that when you look at preferred share capital, Robert, even just go back and I would say there's a cumulative dividend. Just go back. So you have cumulative dividend and non-cumulative dividend. So this, as the word suggests, cumulative, right? So this means that your dividend is going to, you don't want to pay dividends when you are an early stage company, right? Because you have to make revenue. So if an investor is investing, they're buying into the growth of your company. So they just want to have basically your dividend, accrue over time. So dividend, whenever you're negotiating, a good practice is that when it comes to the dividend section in an equity, it should be paid as is in the future. That's the word which is used. So some investors, depending on the company. So for instance, if you are a company which will become sustainable very soon, meaning your business model becomes sustainable, you don't need much cash. You will grow and so on. So in that situation, it can be difficult to get the interest of investors because for them, they want to see rapid increase, but that's not going to happen. So in such situations, if your business is such, you're talking to angel investors, then you can actually structure your dividend in a way that after 3 to 4 years, and that's where you are estimating that you will basically become cash positive, right? So you're not having any losses. So you can negotiate that we will start paying you some dividends in a shorter period of time because we become sustainable. For tech companies, usually they will not pay dividends. They will pay dividends way later on. Okay. So we'll tackle that when we go to the term sheet. So we can go to the next section.
Mm-hmm.
And
you can
here,
also.
yeah.
Okay. Just to give you an example, very, I don't know, hands-on example. I don't know if you're investing at stock exchange or using some platforms, but if you are, I don't know, investing in Apple, for instance, you can have all this information on different platforms. For instance, I use XTB. I don't know if there is active also in your country. But if you are going to this kind of company and use, I don't know, yahoo.com, then you can see all the information regarding dividends, regarding yields, regarding all kind of information that might help you to have a, broader image as a good example. And then you can go, bottom up and try to, dissect each of them. Here is my slide, Gautam, or is yours?
Yeah. No, I will say. So some mechanics of equity round. Okay. Starting first with what's a pre-money valuation. So the pre-money valuation is the valuation of a company before a new investment comes in. Okay. So let's say you want to go to raise investment right now and you're talking to an investor, maybe you need $1 million. So before that $1 million is invested, the investor will determine what's known as a pre-money valuation. And the post-money valuation is the valuation of the company after that amount, that equity amount or new money is invested, right? So simply put, post-money valuation equal to pre-money valuation plus the investment amount. So here I have a very simple question for you. If a company is raising $500,000 at a pre-money valuation of $1.5 million, what's the post-money valuation?
2 million.
And 2 million, yeah. Robert, we can go to the next slide. So it's simply 1.5 million plus 500K. Okay, let's go to the next slide.
Can I ask a question?
Sure.
How do we evaluate how do we come up with the value of the
Okay,
pre-money
I will
valuation?
answer that. So I will
Okay.
answer that question with another example. So
Okay.
I know that that question is going to come. That's why strategically the slide is designed like this. Okay, so let's go to the next one. And then I'll show you an example. I will ask you a question and your answer lies in that question. Okay. So the other elements is at the end of the day, whenever any equity round is happening, right? The key aspect is allocation of new shares. So whenever we are making cap table models, right, for any new investor coming in, we have to calculate the new shares which will be issued to the investors. And in order to do so, what's most important is the price per share, or I denote it as PPS. Okay. So this price per share is, I call it also absolute truth. So when an equity round is going to happen in the term sheet, and I will show you a model term sheet as well, which is very standard. So what the term sheet actually looks like, right? So there is a section where it would be written that the price per share is going to be this much, which is denoted. Now, if you are in a situation where you had a lot of convertibles, it's becoming very difficult to actually calculate the price per share, then the lead investor would issue and state that this is the price per share we are getting or lower, accounting for all the convertibles that will be converting in this round. That's how the language will be written. Okay. So when it comes to the calculation of price per share, this will be equal to the pre-money valuation, which is determined by the investor divided by the fully diluted shares. Now, this term fully diluted shares can confuse people, but simply put, fully diluted shares is the sum of all the shares before that fundraising round is taking place. So in a situation, let's say there was all the founders had 10 million shares, for example, all the founders together, right? So that will be common shares of all the founders. So if you had some options, option pool, allocation, so you add all of that up, okay? And if there was any convertible preferred shares, like any convertible which had also converted, so there was some preferred shares, you just add up all of that and you get your fully diluted shares. So the new shares, basically, you are dividing the new money which is invested in equal portions or shares by that price per share. Okay, so far so good. Should we go to an example? Okay, let's go to an example and take out your calculators. Okay, so a company has raised 500,000, giving away 10% of the company, right? The fully diluted shares before the funding round was 1 million. So tell me what's the new number of shares which the investors will get. Let's take out your calculator and do it. Anyone, if you don't want to unmute yourself, you can even type in the chat, whatever number you're getting. And this example will answer Besnick's question about how valuations are set.
So when we say raises 500,000, giving away 10%, does it mean that the whole value is 5 million? Or
You have to
does
answer
it-
the question, like they
it
calculate the
doesn't
new number of
work like
shares. So
that?
you are raising 500,000 and 500,000 is equivalent to 10% of your company. I gave you a hint.
So is it 100,000 shares? New shares?
No,
Because if price per share, if it is the company is valued at 5 million and there are 1 million shares, meaning that is $5 per share. And if we have the amount invested over the price per share, it is 500,000 over $5. Is it 100,000 new shares? No idea.
no, 100. You're close, but there's one mistake which someone said 5. No, it won't be 5 shares. So
Okay.
it's little bit. Just look at the formulas.
Yeah, pre-money valuation 5 million. Fully diluted shares is 1 million.
Really?
I
Was
think
it 1 million?
I think it's
1
vice
million is fully
versa.
diluted shares, yes, but pre-money is 5 million, really.
10%, 500,000?
Okay, 5 million, but is that pre-money or post-money?
That's post
Okay.
money.
So what will be pre-money?
Now I got lost.
So the 1 million shares is pre-money, or no? The
1 million is fully diluted shares. Fully diluted
Yes.
shares.
You should
Okay,
make the
so
difference.
people are getting confused. Let's look at the
Yeah.
answer. Okay, Robert, let's look at the answer.
But before going to the answer, you should make a difference between shares and valuation. It's different things.
Now the pre-money valuation is that I'm not getting from.
Okay, so let's look at the. So the way we are looking at it is this: investment amount is 500,000. That's how much money you're raising. Equity given away is 10%. So 500,000 represents 10%, right? So your post-money valuation is 5 million. Pre-money valuation, which is
Yes.
the valuation before the new money comes in, that's 5 minus 500K, 4.5 million, right? So now this 4.5 million is your pre-money. So your price per share is pre-money divided by the fully diluted shares of $4.50. So new shares, 500,000, that's the amount which you have to divide by 450. So about 111. Now, one extra step that when lawyers are going to work on this, the total number of shares will be 111,112 because there's no fractional shares. So it will be rounded always. So you round up a share one decimal place. But I showed this to give you an absolute number. Now here comes the question of Besnick. So how is valuation done? Okay. So until a company is even at a Series C or Series D stage, you cannot use the traditional methods of valuation of finance when it comes to companies. Okay. So VCs do not value companies. As I said, they price them. So if you want to find the valuation of a company, you have to do something called a discounted cash flow analysis. And in order to do so, you need a lot of data, let's say 10, 15 years of financial data. Now, in an early stage company, is that available? No. Maybe you're just having 6 months of history. And with that 6 months, I cannot make any prediction of what your value is going to be in the next 5 years, right? So what I will do as an investor is that there is no set formula, but every investor has an ownership criteria. This is hard because they are not going to tell you the ownership criteria, okay? Usually any fund who takes a lead in a round, okay? So what I mean a lead in a round, let's say you want to raise 1 million, okay? One investor comes in and says, we will invest 500,000 in 1 million. And you bring in other investors, we will bring in other investors. But all the other investors would, let's say, give maybe 50K, 100K, some will come in with 150K and so on. So I'm putting majority of the money, 50% of the round. So I set the terms. So this lead investor is going to issue you the term sheet, is going to set the valuation and everything, right? Now, for this investor, let's say their ownership criteria is 10%. Like whenever they invest in a company, they want 10% of the company, right? So for them, it's like, okay, 500,000 should give me 10% of the company, right? But I want to make sure that there are other investors as well. So let me do it like this. I will invest 500K for 10%, but the company total will offer 20%. Okay. So 1 million for 20%, that's your post-money valuation. And then you back into your pre-money valuation. Okay. So it's all a negotiation. So whenever you're talking to investors, for example, a lot of accelerators, right? When you go through some accelerators, they would say that we are going to help you with, let's say, your business or introduce you to a lot of investors. And we will not take any money from you, but we want a certain percentage of the company, right? So they would say, we will take fixed 5% of the company for all the services we provide. That's known as services for equity. But there are some accelerators who will give you some money. Let's say they would say 100K we will give you, and the cost will be 10K, which we will take out of that. But for 100K, we want 5%. So in a way, they set the valuation immediately, 100K for 5% of your company, right? And in UK, you have this SEIS, EIS funds. So they immediately have an idea, 250K pounds for 7.5% of the company, fixed. That's how they do valuations, right? Because at the end of the day, they are pricing it. They can't value companies. So what you have to know is that when you will approach investors and you get to the advanced stages, you will negotiate money and the percentage, okay? In proper seed rounds, usually you're looking to give away somewhere between 15 to 25%. 20% is like your median. When you are doing a pre-seed round, now I know in Europe, especially in nascent ecosystems, investors want a good chunk of your company at a very lower valuation, meaning that if you compare US, where someone is raising 250K, they would want to give away equity which is less than 10%. That's a best practice. But here it would be a fact that if you're raising 250K, someone would say, oh, we would want to, let's say, buy out 30% of your company for that. I saw this happening a lot in Italy. So you want to preserve your equity as much as possible. And then they will ask you questions about, okay, how you're setting the valuation and so on, like if there is any number or multiple. But if you think about the multiple aspect, right? So choosing a multiple to set the valuation, even in early stages, it's not going to make a lot of sense. So let me give you an example that let's say you're making 1 million in revenue, okay, and you're a SaaS company. So when it comes to SaaS companies, usually their enterprise value to revenue multiple, right? Like what's the multiple you multiply with your revenue to get the valuation? It's usually somewhere between 4.1x to close to, let's say, 6.5x on a median basis, right? So if you are a very star company that you have a lot of customers in the contract, of course, you can go 8x, 9x, and so on. But if you take an example, if you are making 1 million in revenue and you take even a 10x multiple, let's just say 10x multiple. So that means your valuation right now is 1 into 10 million. Okay. And you would say, okay, right now my valuation is 10 million pre-money and I want to raise some money, let's say 2 million. So if you would want to raise 2 million, 2 on 10, post money, it's like 20%. But if you are making 1 million, you would not want to raise 2 million. You would want to raise much more money, close to 10 million, actually. So if you were wanting to raise 10 million and you would want to give away, let's say 10% of the company, that's 100 million valuation. So you would not be able to get that. Even if you do 20%, it's like 50 million valuation. So that multiple is like what? You will have to do 50x into 1 million, right? So it's all negotiation. Even at a Series A stage, it boils down to negotiation, even though you are going to have a lot of metrics, okay? So what you definitely have to keep in mind is you have to look at the market, what's happening. So I'll give you an example. Like whenever I look at European and US markets, valuations at the same stage in Europe is close to, it depends on where you are. So if you are in UK, think about your valuation will be slashed up to 70%. So if a company in US gets valued at 10 million, let's say UK, the same sort of metrics, if you see, it will be close to 7 million. If you go a little bit more towards Germany, Western Europe, then perhaps it's going to be closer to somewhere like 6.6 million, 6.5 million, like that. And as gradually you move to Eastern Europe, it's going to be a little bit lesser, okay? So Besnik, did you understand like how valuation actually the game is played, right? So you have to know about what's happening in the industry. You can go to whatever like
backwards approach.
Okay.
Reverse engineering approach.
It's all reverse. You have to always back into it, right?
Yeah.
So that's how it's all set. It's not set like pre-money. Everything gets decided on the post and then it comes to the pre. And then everything is basically structured. Okay. Let's go to the next slide.
Gautam, may I?
Yeah.
Also, I think on the valuation, not only 1 million revenue, but it depends also on the earning you do after taxes. Because in that 1 million, if you do only $50,000 or like earning, and you have a very low percentage of earning, then you cannot value it on 10 million. But if you have like 60% like revenue on that 1 million, let's say you do $600,000 of gain after that year, it totally changes the picture. It's not only the 1 million figure in total revenue, but is more on the because if you do 700,000 and the guy can think that okay, 20% gives me 140,000 of gains of earnings per year. Maybe they can consider this and that, blah blah blah. But I think it's also it's very. Correct me if I'm wrong.
Okay, so as an investor, I'm not concerned as much on your net revenue in super early stages. So my objective right now, that's why the EBITDA multiple, for example, if you have, if you Google about it. So for early stage companies, your EBITDA will be negative, right? Most of the time. So if your EBITDA is negative, we can't use EBITDA multiple to value the companies. If any multiple is negative, because you can't have negative valuation, right? The logic is simple. It should be positive. So as an investor early on, and a lot of VC investors, they are focusing on growth, right? So they are irrespective right now, burn money. That's the logic, that burn money. We are giving you the money to burn money. Now, this is also in line with another motivation this is specific to a lot of VCs, okay? VCs usually don't want to see a very sustainable business model, because the moment they see sustainable business models super early on, maybe the growth will not be there. I'll give you an example. So when Microsoft was trading, they were not paying dividends and the stock price was going up and everyone was happy. Then after 8 to 9 years, they paid dividends and the stock price came down by a big number. And at that time, when the analysts were writing about it, they were basically writing articles like, has the growth stopped? Like, that's why they are paying out dividends. Like, have they become sustainable, that it's not going to go like this, right? So for a lot of these investors, they are not going to be focused as much right now in the early stage on what you get after taxes. They are going to be focused on how much more money revenue you would be bringing in, because that's what they want to see. And later on, all the other things, they are going to fix it up. And once you are in that path, that of course, they are going to look at your net margin. So of course, if you are in a very capital intensive industry, right? For instance, consumer goods and so on, your margins are not going to be that good. But even in early stages, when you are starting off, your customer acquisition cost is high until and unless you develop your own positioning, your organic growth and all of that. So that's why they're giving you the money. So this is I call it the burn mentality, right? So they want that. So that's why they focus mostly on how much revenue traction, how much growth is happening. They don't look back as much. Like, that would be a way to look at companies in growth and later stages. So that is where we get extremely concerned on what's the net profit, what's the net margin right now. And from there onwards, because the thesis an investor builds becomes different. So every investor builds a thesis on why they are investing in your company. So if you are an early stage company, again, it's like growth. But the moment you come to growth and later stage, now I'm wondering, okay, if you're doing 500 million in revenue, can you go to 1.5 billion, which is a massive leap? Like, you have to create a massive amount of wealth. So if you're going after enterprise contracts, what's left out there? Like, are there really enterprise contracts left that you would be able to get it to 1.5 billion, or you will have to get into different segments by acquiring companies? That's why from Series B, C onwards, when companies are raising money, they acquire other smaller startups in order for them to grow or come to any new country and so on. So did that explain to you, like, what's the logic behind it usually when they look at? Okay. So let's get to option pools.
Maybe one final comment from my side regarding the valuation. Here is a pitfall that you need to avoid, in the sense that sometimes all the discussions are around, valuation, which is not very relevant. I mean, it's relevant, but not the most relevant in my perspective. What is happening sometimes is that you are spending too much time on the valuation, negotiating with investors, and probably you might get a higher valuation. And after 18 months, 24 months, when you're looking to raise a new round, if you're not able to accomplish all the KPIs and milestones that you want to achieve, there might be a probability that your new valuation after 2 years might be lower than the first one. Meaning that for you it would be almost difficult to raise money, because for the next investors, they would say, okay, they were valued at 10 million and right now they are valued at 8 million after 2 years. What the heck was happening in there? So you need to pay a lot of attention. In the end, it's and one investor told me one time, the best valuation that you can get is that one that you are having at the end of the day. So no figures, just imagination, just negotiation. And what is important actually is not just the valuation, is to take the money that you're looking for, because you are spending too much time on, different figures. And by the way, I will send you after the workshop a very good Excel. You can, try to play with it. It has 2 different scenarios with different methods used for pre-revenue startups and post-revenue startups. So you have different, scenarios. You can play with them and you can try to create your own valuations. That's all.
Thank you.
Okay. Let's get to option pools. Okay. So if you're familiar with option pool, that's all great. If you're not familiar with option pool, okay. So option pool is basically a set of shares which are set aside for key employees of the company. So as a startup, when you're growing, even after you get the money, it's still difficult for you to get the top talent. You can't pay super high salaries. So how you can compensate for that is that you give them some shares of the company as options. So any employee which gets the option, they have the option to buy a certain number of shares at a predetermined price, usually known as a strike price. Okay. So if you are a super early stage company, you can say, well, 0.001 cents at this price right now you can buy. And when the value of the company gets bigger and bigger, you are at an IPO event or you want to sell it back. So you can say, oh, I had 100,000 shares. So I will buy them at my strike price, which was 0.001. And now they are worth, let's say, $70 a share, right? So now I can cash out 100 into 70, right? And then 100,000 into 70 and whatever was the difference. So that's your options, right? Now, when it comes to option pool, how they are structured, what are some best practices? So this graph, when you take a look at, this is from Index Ventures. They looked at about 200 companies. And when you are starting off, so inception is you just started the company. There is basically all the founders. Maybe it's like, 30, 30, 33, 33, 33 or 50, 50, something like that. Then you raise a seed round of funding. You're giving away somewhere close to 20%, right? And whenever you raise a funding, if you don't have option pool, the lead investor would definitely say that you should create an option pool, maybe 10%, 15%, or 20%, something of that sort, right? But usually I've seen if there is no option pool, they would say 20%. Let's start with 20%. Now, over the years, when you go to series A, B, C, D, and so on, whatever be, so you will be giving these options to employees. So some options will get allocated and some will get available, but you are hiring more people. So you have to have this pool getting bigger and bigger, right? So that's where if let's say you gave away 10% and now you are left with after that funding round, after some time, maybe close to, 5% you are left. So in the next round, the investor says, increase this option pool. Okay. So increase it back. So you have total available close to 20%. Right? So that happens in series. And gradually, this is how you are going to take a look at as more investors keep coming in, the founder will gradually keep on getting diluted. And what's also important here is that you should, that's why I said preserve equity. So if you are at a seed stage and your cap table looks like a series B, where investors have a big chunk, then this can scare away other investors because they would be seeing that, okay, the founders own already so less, like what will be the motivation because they're already a minority. What will be their motivation, and the others, if things are going well, they are not going to sell because their value is appreciating, right? So what will I be able to get? Now, in certain circumstances, some investors can say that, okay, we invested in seed, now it's series B, we want to sell a portion of our shares. That's known as secondary transaction. And the new investor can say, okay, I buy a portion from there and I buy, let's say, another portion. So the founders are getting diluted. So I'm close to whatever is my ownership criteria, which I'm getting. Okay. So options do have a vesting period. So vesting period, it depends. The standard is your 4-year vesting period with a 1-year cliff. So an example would be that if an employee gets an option to have 100,000 shares, okay, so that employee is not going to have that 100,000 shares on day one, because what if he's like, okay, let me take that 100K, I exercise it right now. Some other investor says wants to buy it, bye party, right? Now I'm going to Thailand to party, right? So what's going to happen is that this 100,000 will be divided for 4 years. So 25,000, 25,000, 25,000, right? But even within the first year, now this 25,000 gets divided by 12. So about 2083, 2084. So every month, this person is earning 2083, 2083, 2083. Now in the first year, if the person leaves, will get nothing, right? But once the first year is completed, 25,000 shares are minimum assured. So if leaves just after 12 months, then 25,000, right? If leaves after 13 months, then 25,000 plus that 2083, so about 27,083, right? So that's what's known as a vesting period, like 4-year vesting period with 1-year cliff. Okay. So depending on what's the contribution of a person, how much the person will be bringing in growth and so on, that's where you can allocate options. So for co-founders, usually you already have the common shares. But if you're bringing in someone who's going to basically play a very crucial role in your company, you should always start off with a small number of shares. And if, let's say, you hire someone at a C level who will be representing the company and spending a lot of time, then more than 5% for sure over a period of time. Not like immediately start with 1% and so on. Okay. But do keep in mind that if the CEO is someone who has been hired fresh, was not part of the founding team, then the option plan has to be set in a way that this person comes close to 10% over a period of 4 years. Because if the CEO is a person who is going to own very less, let's say 1% or 2%, then an investor would think, what if the person bails? And these are scenarios I have seen play out a lot of times where CEO was, I would use the phrase, a hired gun, and then bailed after, let's say, 6 to 8 months when things were not looking great. And investors were, again, not investing because of this crucial fact. So this is why cap table at times can also make or break your case for investment as well, even if all other things are in line. Okay. Let's go to the next one.
Maybe one final comment here, Gautam. Regarding the shares that you as owner should have, in the market there is a rule of thumb which says that after Series A, the co-founders should have more than 50% of the company. So that means that after 3 rounds of investments, you who actually started the company should have more than 50%. And if you're looking in these columns, it's somewhere like in there. So Series B, I can see that the investor have 55, 53%. But usually bear in mind that you shouldn't give at any round more than 10, 15, 20% of your company. And after Series A, meaning the 3rd round, you should have at least 50% in your company.
So when it comes to creation of option pool, there are 2 methods. So in the last example, I was saying, okay, 10%, 20%, and this is very important. So whenever you're creating, you have to make sure with the lawyers that it should be usually pre-money option pool, which is a standard. So what does this mean, pre-money and post-money option pool? So these are 2 methods. And as the name suggests, in a pre-money option pool, the option pool is created before the new investment comes in. Okay. So this means that the founders will bear the dilution of the option pool. Now, the new equity investor is not going to get diluted. So if I'm an investor and I say, I will invest 2 million, 10 million post money or 8 million pre-money. Okay. So after option pool is allocated, I will have 20%, 2 divided by 10. Okay. That's it. So I will not get diluted. So this option pool, which will be created additional, maybe it's 10%. So then the founders will get diluted, right? So they would be down to about, let's say they do 80, 70%, and that 10% option pool is created. So this is pre-money option pool. This is the standard. So here the post-money valuation after allocating new shares is not going to change. So after you have done all the allocation, when you take the price, the price per share for that round, and then the fully diluted shares after allocating the new investors, that should be equal to the post-money valuation, or in my example, 10 million. Okay. Now, there is another method called the post-money option pool. So here, as the name suggests, the option pool is created after the new money has come in. Okay. So here, the founder and investor both will be diluted. The equity investor will get diluted too. So what's happening here is that the post-money valuation is changing because of the creation of the option pool. So in this example, if I say 2 million for 10 million post-money, I will not have 20%. I would have something less than that. And this option pool will be created after. So meaning, think of it like the post-money valuation would be calculated as follows, that you have 10 million, right? 10 million represents like 90% of the company now, right? So you are actually going to have this value of option pool, which you divide by the total value, which is the post money plus this option pool, that will be equal to 10%. So I'm showing you as a simple linear equation, and you solve it, and that's how you get the post money option pool. Now, why will this be used, or why will any investor agree that I should get diluted, right? That right now I'm investing and so on. So this happens in situations where things are not looking good. So it happened during pandemic. So where companies needed more money, the existing investors had to give more money. But the existing investors understood that if we give more money, we will have more equity. So if we are going to have more equity, there will be less left for the founders. And in order to retain employees, in order to get those employees when they are hiring, the option pool needs to get increased. So how about all of us get diluted? So that's one situation where a post-money option pool is going to be used. But in practice, it is very rare. If things are looking good, you go for a pre-money option pool. Okay. And I have some examples. So Robert, you can go to the next slide. So here is some formulas. Okay. So when it comes to the allocation of pre-money option pool, basically you have to calculate in the end the option pool shares, okay, which is like the lowest one. And there are two methods I have shown for the pre-money because that's the most relevant one. So first, what you do is you calculate the value of an option pool, okay? So this will be post-money valuation times the target option pool percentage. So if it's the first time, then let's say 10 million is your post money and 10% has to be the target option pool. So this means the value of option is going to be 10% of that 10 million or 1 million, right? Now, one method is that if you think about this transaction, 2 million is coming in, but additional 1 million you are creating, right? So in a way, you can say that 3 million is a total money for which I'm allocating shares. 1 million of that option pool and 2 million, which the seed investor is investing, let's say. So you have an effective pre-money valuation, which is pre-money minus option pool value, right? So it will be actually now 7 million, 10 minus 3, not 10 minus 2, because that option pool is getting created. So your price per share now becomes, let's say if we had 1 million shares, it's not going to be 8 divided by 1 million or $8, but $7 here, because you're creating that option pool. And so you can just say option pool shares, there's going to be that 1 million divided by the price per share, which is going to be your $7. Okay. So this is one method, but this will not work if you have a lot of other convertibles converting and so on. It can get very complicated. So there is a direct approach in Excel which you can use. So here, what you're going to do is you're going to divide the pre-money valuation by your fully diluted shares and option shares. And now that represents the confusion, because you are calculating the option shares. So how can you use it to determine the price per share, right? So this is what's known as a circular reference or a circular function or iterative calculation. So in Excel, in Google Sheets, you have the option for that, okay? And you just feed in the data and Excel will basically calculate going again back into the calculation. Now, this is a method which I use always because this is much easier in complex scenarios. And a lot of lawyers would fear using it because it is complicated. They usually fear, right? So when you use this method, especially when you have convertibles and safe, it's going to give you the same price per share. And then with option pool shares, you can just do option pool value divided by price per share. And if you're doing a post-money option pool, your price per share is going to be pre-money divided by fully diluted shares. So here you are assuming it's actually going to come on top of that 10 million, right? But the option pool value will be your post-money valuation 1 minus target option pool percentage. So you're basically assuming that whatever is going to be left is the post-money valuation is 90%. Okay. So you divide that by the post-money valuation, you multiply the target option pool percentage, and then you get your option pool shares. So that will be option pool value divided by your price per share. Let's go to the next slide. So it becomes a little bit easier. Okay. So this is a slide I have for option pool increase. So let's say you issued option pool and then you want to increase it because it decreased, right? So when it comes to the current price per share, now we are going to use circular functions. Pre-money valuation divided by fully diluted shares plus the new option pool. So again, you have to find that new option pool, but it's already fed in, right? So the new option pool value will be your post-money valuation times the new option pool percentage. So let's say your valuation was 10 million. In the next round, it is 20 million. And now the investor says that available should be now 10% of that 20 million. So now your new option pool value will be 10% of that 20 million or 2 million. Okay. But you also had existing option pools. So you take all of the existing options, allocated and unallocated, and you multiply by the current price per share. So that's the value of your existing. So new should be this much. This is existing, right? So you have the gap And for that gap, you have to allocate the shares, right? So the value of options to issue is your new option pool value minus the existing. So whatever is remaining, you divide that by current price per share, you get your new option pool shares. So that's how you can do the calculation for new option pool increase. Okay. And for post-money option pool, here there is basically another step to think about. And here what you have to do is that your post-money valuation is going to change. So you are actually going to look at the value of your post-money as the fully diluted shares. After that round has taken, you'll just assume, because you set up a circular function, times the price per share, and then you take the target option pool percentage. Okay. And then similarly, you have the existing value. So that will go into the current price per share. So new minus existing, and then you divide it by that. I'll actually send an Excel which has a lot of examples solved and unsolved, so you can play around with that. Okay. Okay, now I will confuse you guys even more. Okay, so this is known as conversion method. So you will get extremely confused right now. So whatever we talked so far, right, that a new investor is investing 2 million on, let's say 10 million, getting 20%, right? The new investor never gets diluted. That's the main theme. New investor, if they are investing, they don't get diluted. And that's the standard. That's known as the percentage ownership method. Okay, so in this case, the post-money valuation is fixed. So whatever convertible is converting, whatever option pool, at the end of the day, it will be that post-money valuation, 10 million fixed. Okay. If you're going to introduce an option pool, that will dilute the founder. It will not dilute the new investor. So any convertible, if you have, which is converting, that's not going to dilute the new investors. That's what's known as percentage ownership. But as I said, there are cases where the founder's ownership has to be preserved by the investor. That's where the two other methods come in. And there is a way I have structured dollars invested in the middle and pre-money actually on the right. Because when you look from left to right, percentage ownership is the most investor friendly, least founder friendly. Pre-money is the least, I would say, investor friendly and the most founder friendly. Because in a pre-money method, the investor will have maximum dilution. Okay. So in a pre-money method, the pre-money valuation is fixed. The post-money can increase. So if the post-money can increase, if I'm investing 2 on 10, that's how I'm going, and it's a pre-money. So I will not get a 10 million, maybe it will be 11 or 12, depending on any option pool which is going to get created, any convertible which is getting converted. So when all of these things are happening, it will start significantly diluting me. Okay. So any option pool will dilute me, any existing convertible or safe is also going to dilute me. So that's what's known as a pre-money for an investor. This is the least friendly method. Now, in between, you have a dollars invested method, which is known as a compromise between the two extremes, percentage ownership and dollars invested. So in a dollars invested method, you calculate all the dollars which are invested in a company until we are at that fundraising round. Okay, so we will calculate an effective pre-money valuation in this concept. So if you say that I'm investing 2 million and a post money of 10, my pre-money is 10 minus 2, 8, right? However, the company had raised, let's say 1 million beforehand. Okay. And when this 1 million was raised, it's going to convert. So right now, because this 1 million is getting converted, the total dollars invested as of that moment is actually 2 plus 1. Right? That 1 million was also invested, right? So I look at the total dollars, and here the post-money valuation will be arrived at by adding all the dollars invested in the pre-money valuation, meaning it's not 8 plus 2, but that convertible, that 1 million will be also added. So it will be 8 plus 2 plus 1, 11. Okay. So of course, as the post-money valuation will increase, now I'm getting 2 on 11, not 2 on 10. So I'm getting diluted. Right? So any safe or any convertible with an accrued interest, it's going to be included in that total dollars. An option pool will also dilute the investor. So usually in an example, think of it like this. If I go percentage ownership, I get 20%, maybe dollars invested, depending on how the conversion is happening, 19 point something, and pre-money can be 18 point something. Okay, let's go to the next slide. So this is basically some formulas which I have. Percentage ownership we have already talked about. So with an option pool, this is already what we have covered. And so I will focus more on dollars and pre-money. So dollars invested, you have your pre-money valuation, which is the agreed upon pre-money valuation. But then you calculate an effective pre-money valuation, which will be your pre-money plus any convertible with the accrued interest. So your post-money now becomes effective pre-money plus the equity investment. So as I said, it becomes basically 11 instead of 10 from my example. Okay. Now the price per share you will calculate will actually be calculated on that effective pre-money valuation. Okay. So that will be effective plus fully diluted. Now you put in convertible and options. So whenever you're putting these numbers in the denominator, it's reducing the dilution for new investors. So that's why you see in pre-money, it's straightforward pre-money divided by fully diluted shares, right? There is no convertible or any option pool shares included in the denominator. And that's a signal that a new investor is getting maximum diluted over here. And the option pool value, that's the same logic. You take the percentage times post-money valuation, and then you're going to divide that by price per share. And then your pre-money valuation, that will be pre-money divided by your fully diluted shares, like complete full dilution. Okay. Let's go to the next slide. Okay. So here I have an example for you to show you, and maybe we'll have to, I think we don't have to zoom in. Okay. So here you can see that a company raised a round of 1 million via convertible note. Okay. And that converts in the next equity round. Now the note had a valuation cap of 10 million. We'll cover all of that, what's valuation cap and those kind of things. And after 20 months, the company raises a Series A round of 5 million, giving away 20% of the company. Fully diluted capitalization or fully diluted shares, that's 10 million. Lead investor negotiated creation of an option pool on a 10% on a pre-money basis. Okay. So here, when you look at the percentage ownership method, so the new investor is going to have 20%. Okay, because they are raising 5 million, giving away 20%. So they have to get that 20%. So they get that 20%. Now, option pool 10%. Yes, that 10% is created. And now this 1 million convertible gets 6.36%. Right. Now, when you go to the dollars invested method, now it's 19.23%. More for convertible investor from 6.36 to 6.43. So when it comes to the ownership of all the founders, you can see it's slightly more. And when you go to the pre-money, so here you can see the founders will retain the most, but the seed investor is getting diluted to, let's say, 16.67% here. So it's like the maximum dilution. So this example shows you that the percentage ownership is the most friendly for an investor. Pre-money is the least friendly. Okay. So usually you're not going to encounter dollars invested or pre-money, but let's say you messed up. Maybe you will have to opt for this kind of method. And let's say your traction is not going well, but you need the money you're negotiating. Okay. So these are very rare cases, but in a downturn, that can happen. I'm pretty sure people will be confused, but let's say go back to it multiple times. And when you look at I will send an Excel with a lot of case studies and exercises, then, play around with it. Then you will start understanding. Okay. Even a lot of, I would say, so I teach venture capital as well. And a lot of these associates and analysts I have trained. So I've trained more than 500 people so far in my life. They get confused for the first time whenever they see cap table options and all of these things. Okay, so you're not alone. Now let's get to convertible note after this. Okay, so Robert, we can go to the next slide.
Yes. I was just curious if they need a break of a few minutes.
Break or brain fried, anything?
I guess we need a break because this is very intensive. It's not like just discussing. So
yes, this will get intense. It will get even more intense as we move forward.
So
we can take 5 minutes of break.
5 minutes break. Let's do 5 minutes break.
Okay, so we are back. I hope that you took a coffee, took some oxygen for your brain, because there will be another 2 amazing hours. Yay!
Yeah, so you can find a list of investors. Just make a free account on, for example, Crunchbase. Okay, Crunchbase has an option called Find Investors, and they have a lot of filters. So you can filter down only in, let's say, Central Eastern Europe. So select all the countries, and it will show you, okay, what kind of investor you're looking for: angel, VC, microfund, everything. Right? That's one avenue. The other, of course, is that you can reach out on LinkedIn. Some would say that always go for warm introduction, but don't discount cold approach as well. So investors are always looking at, let's say, cold messages as well. I have done transactions where founder reached out to me cold, didn't even know him. And he sent me a very short, quick message, 1-pager. I looked at it, found it interesting. Immediately I replied, okay, let's have a call, right? So that's another method. Then if you are, let's say, with going to any accelerator, if they have investors, ask them to introduce you, right? Or if you find anyone in the CE, you can ask Robert that, okay, this is an investor I found, and can you make an introduction, or can you tell me whether they are investing or not? Okay. So that will be another one. Pitch book is, I would say, very expensive, so don't go for that. F6S, I think, Robert, that's what it is. I think they also have, right? So that's another avenue for you to search, right? And apart from that, I would say there's a lot of blogs which are published, like top 10 active investors in this region and so on. I think, what's the name of that company? Westby, it's the Polish company. Yeah, Westby Publishers. Yeah. So
I also sent a link to Zen this week with an open tool where you can find the investors according to your geography, to your ticket size, to your vertical. So you can just filter in there, and you can, map your own list of investors. And if you are Google it, for instance, or looking on X or on LinkedIn, then you'll find a lot of useful databases. We are following a lot of people on LinkedIn, and we do have access to various sources of investors, but mainly are the ones that were mentioned by Gautam. I don't know if you've been, Iri, to the first workshop, because we've been discussing about this. Okay, that's why. If you're looking to the first presentation from the last week, then you will see a lot of useful links and information regarding how you can reach out to those investors as well.
All right, thanks.
You're welcome.
Okay, let's go to convertible notes. Okay. So convertible notes as an investment instrument, this is another instrument to raise capital compared to equity round. And this has been around for a very long period of time, and it has different names. So you can say convertible loan agreements, CLAs, just a convertible note, or anything like that. The main characteristic of this instrument is that it is a debt instrument. Okay, so I'm not talking venture debt. Venture debt is a little bit different. So this is primarily a debt instrument. Okay, and when you look at a convertible note document, it's usually longer compared to something called SAFE. It can be 19 to 22 pages long with all the provisions which is going to be there. And the SAFE is usually very small, 5-6 pages or 9 pages. Right? Now, in a convertible note, when you are raising money, the investors do not come into your capitalization or cap table or share table immediately. Like right now, if I give you, let's say, 200,000 on a convertible note, I am not in your cap table. Basically, you maintain your cap table saying, okay, founders own this much, and we have a convertible register. We raised 200,000 on this date. Okay, but it's not converting as of now. Another advantage of convertible note over equity is the fact that you need to have all investors lined up before you do an equity round. So if you are raising 200,000, someone says, I will give you 50K, someone says 50K, 75K, and so on. So until you have that all secured, you can't take in the cash, you have to wait. And then once you have all of them, then you send them over their documents, like investor rights agreement, stock purchase agreement, right? All of those things. Once they get signed in, money is then wired into your account and so on. But with a convertible, you can continue raising. So you find someone who says, I can give you 50K. You can just take the 50K and you continue raising. Then you get some more money, you sign the documents, you take it, and you continue. And of course, there is no concept of like a lead investor in a convertible, but anyone who is early on setting the terms within a convertible note, think of it like a de facto lead, where they would say that this convertible will have this much interest rate. Then there are some other instruments like valuation cap, discount, all those kind of things. So everyone else is going to basically follow on that, right? So that's how a convertible note is structured. But do keep in mind that at the end of the day, it is a debt. So there is going to be a clause which will be stated as repayment of debt. However, the investor would not want you to pay back the convertible instrument with an interest, because they will lose out converting it into your shares. So earlier, what used to happen is there's a company called Top 10. Okay. okay, top talent, top tel. They raised a convertible note and there was a repayment clause. And what the founder did was that once the repayment date came, he repaid the convertible note with interest. And he's like, okay, done. The company is growing. And investors were like, what? We wanted to get into your cap table because now the value will go up. And the founder was like, hey, there was repayment. I just paid you with that interest. So whatever they invested, they got like a small interest on that. But if they had, converted into the share table, they would have even able to get 3x, 4x, but they lost out on that opportunity. So that created a lot of mess and lawsuits regarding that. But when it was read that he just exercised it like that. Hence, investors will actually structure the convertible in a way that if the repayment date gets there and you have not been able to raise any equity, they will still convert. Okay. There is an interest rate on a convertible which you don't have to pay per month. So if you're raising money, let's say 200,000, there is an interest rate of 3% or 10%, whatever it be, it's going to get accrued. Okay. So you are not going to pay the interest every month. So when that convertible is going to get converted, there will be a maturity value until that point of the day of conversion that will get converted. Okay. And in some countries, Europe mostly, a 0% interest convertible, you would see, that's basically to replicate a safe. A safe instrument does not have any interest rate. Okay. So you will see that it happens in Eastern Europe as well. There will be no interest rate. It's just a way for investor to use it like a safe, but with some additional, let's say, conditions. Okay. So even if there is no equity round, which is raised after raising convertible, it will have a condition for the investor to convert. It can have a valuation cap, discount, or something known as a no cap. I will touch upon it later on. And convertibles are also of two types. Further confusion for you guys, a pre-money and a post-money basis. Okay. So let's get to some more terms of convertible. Yeah. So in a convertible, first you will have the principal, which is the amount which you are raising by a convertible note. Let's say you want to raise 200,000. So that will be your principal, 200,000 total you want to raise. The interest rate, that's going to be the interest rate on principal. It can be simple, it can be compound. I've seen mostly a combination of both. So simple is usually better. Maturity date, that's the date on the date of the issue of the convertible when it becomes repayable. Okay. The maturity value, so that's the final value. And I'm talking like, I don't know, high school mathematics over here, which is your principal plus accumulated interest. Now, it's important to note that shares are always allocated to the maturity value. So if you had like 200,000 and after 24 months when it's converting, maybe it's 210,000, that 210,000 will convert, not 200,000. Okay. In a safe, because there's no interest rate, the principal basically converts. Okay. Now, convertible note is used because in an equity round, you have to set at least a price or a valuation, right? You want to forego, like you don't know what to do. But still, as an investor, you would have a valuation cap, meaning the valuation or valuations. Now I have an S over there because there can be different valuations for the same company depending on the scenario. An investor can do that. That customization is mostly offered by a convertible note. Okay. So if I'm an investor in a convertible note, here is how I'm thinking. This company is super early stage right now. I don't know what the valuation is going to be, right? And I want to wait until the company is able to raise maybe, let's say, 2 million. And that's going to happen maybe 36 months from now from proper investors. So at that point, I would say that if they will raise, now I'm estimating, let's say 2 million after 36 months, they would be at a valuation of, let's say, 10 million. So I would say my valuation cap is going to be 6 million. So while the new investor comes in at 10, I will convert at 6. Because I took the risk of investing right now and the investor will come later on. So they are actually investing when the company is less risky compared to mine. So that's why I put it like 6, or I would put it even like say a 5, right? Now, discount is a percentage discount. So it's usually denoted as 10%, 20, 30%. Market usually is like 20% for early stage companies. So this is the percentage discount on a price per share, meaning if the equity round investor is paying €1 per share, €1 per share, I will get a price per share, which is 20% discounted from this €1 or 80 cents. So I'm getting a lower price. So I always want, as a convertible investor, a lower price per share so I can get more ownership. right? Your denominator is getting smaller, so you get more ownership. Now, that's the entire idea of an early stage investor using a convertible note or SIF. Now, let's go to the next one. So I will explain. Yeah. Now, most favored nation. So most favored nation is a clause which will be in a SAFE as well. So this clause basically allows any prior investor to get the same terms as a new investor. For example, let's say you are raising 500,000. I come to you and I say I can give you 20,000, but I'm not an experienced investor. I don't want to set any valuation cap discount. I don't know. I love your idea. I just want to invest, right? Or I'm your friend. So you take the money and you say that I will give you most favored nation. So you take 20K. Later on, you find someone who says, oh, I will give you 100K. I'm a more professional investor. So we will be doing 100K valuation cap of 3 million and a discount of 20%, right? Now it's set. So the first investor who had most favored nation would say, so, okay, so I also get the same valuation cap and I also get the same discount, right? That's what basically most favored nation does. And then from there onwards, once you have the valuation cap and discount set, every other is going to come at the same valuation cap and discount. So for super early investors, you can use the most favored nation. Now, capitalization, this is a section within a convertible note. So in a convertible note, now this is something which you will talk and have clarity with your lawyers. That's why I say you need to have very good lawyers who understand venture transactions. Majority of lawyers actually don't do. And I'm talking it from experience working in many firms, working with many lawyers. Capitalization section basically states how the convertible converts. So how the division will happen. It will basically say this will be a valuation under this, let's say, event, and it will be divided by this price per share. And then this will be condition 2, condition 3, condition 4. So it's clearly outlined. But sometimes the way it is written, it can get confusing. Okay, so you want to have, that's why a pro forma cap table, whenever you are going through any transaction and you have it agreed with all the investors that this is what the cap table looks like before investment, this is what it will potentially look like after investment, and have it basically completed. A lot of lawyers at times are like, I don't want to do this, or it's all straightforward and so on. Probably they have not done the math, and this can create problems. Like, let's say option pool was created on a post-money basis while it was pre-money basis, right? This kind of things happen. Now, I talked about the different conditions. So a convertible note will have at least 2, qualified, non-qualified, or long stop as well, 3, but those 2 will be there. Okay. So qualified financing is the best scenario for a convertible investor, where the convertible investor would say that, okay, in the next round, equity round, if the company is able to raise 3 million, then I will convert at an X valuation cap. Okay, that's known as a qualified financing. Best scenario, like company is growing and they are able to raise 3 million. But let's say the company raises 1.5 million or 2 million. It's okay, not that good, but still okay, right? That's known as non-qualified. So things didn't go so well. So I will convert at a lower valuation cap because things didn't go well. And I want to get, again, more shares, more ownership. And a long stop is where the least favorite, nothing happened. The company was not able to raise any money and the time has passed 24 months. So I will raise at an even lower valuation. So let's say for qualified financing, if I say everything goes well, I convert at a valuation cap of 6 million. Non-qualified, let's say 5 million. Long stop, 4 million. So this will be different conditions. So at least the investor has clarity that in any of the situations, this is how I'm going to get converted. Okay. Any questions so far? No. 1, 2, 3, 4, 5. Okay, let's move. Okay, so to confuse you guys, again, convertible is also of 2 types. So you have a pre-money convertible and a post-money convertible. Okay, now I talked about the conversion methods before this because of this issue. So most common is the left side, which is the pre-money convertible, which follows the percentage ownership. So this means post-money valuation is fixed, new equity investors are not diluted, founders bear the dilution, and so on. So this is basically a percentage ownership, the usual way. This is how convertibles are done. And there, case by case basis, there is post-money convertible. And in a year, if you take a look at all the convertibles which are issued, maybe you will find 10% from the data which will be post-money convertible. So this follows the pre-money method. So you go to conversion methods, the pre-money method. This is where the new investor will basically get diluted. Any option pool we create will further dilute the equity investors. So this again, for those adverse situations where company is raising money via convertible and there's going to be very less equity left, then investor would state, okay, let's get diluted in order to preserve the equity. Okay. Let's go to the next one. So this is again very similar to what we had on the percentage ownership, and this is basically on the pre-money method. Okay. So I won't spend a lot of time. It's basically, you can just read upon from the formulas, fully diluted shares, as I said, right? And here is an example scenario, Robert. Your slide, you can explain it.
Yeah, so basically, I believe that this might be also too much information, but in a nutshell, take your time and look at this example. Mainly, it's based on a convertible note of 25K, if I'm not mistaken, yes.
Yeah.
And then to be able to calculate everything related to discounted price, price per share, so everything that was stated before by Gautam. And you can find any kind of examples on Wikipedia or Yahoo.com or different other websites. It's basically you need to understand, but how I better understand is using Excel. So Gautam will be sending the Excel to them and try to play with those figures and put some numbers in there. And of course, this exercise might be too early for you, but at least can help you in further discussions with investors if they tell you, what do you think about having a CLA instead of equity? Then the information and can continue discussing with them. Hey, I made some projections according to our I don't know status. Then we are able to give you 25% discount and whatever. So might be a leverage into the negotiations that you're having with the investors. What I believe is important in here, for you need to be clear what is the difference between equity and convertible loan. Or convertible note. Basically, the main difference is that this is a loan, kind of a loan, and there are direct money, and they have direct equity. For instance, in Romania, lately, many investors are using convertible note or convertible loan because of many reasons. One of them being that they avoid the valuation of the company, one. And then in terms of rapidity, a CLA might be signed in, I don't know, maybe 2 weeks or 1 month instead of for equity, which takes up to 3 months. Because there you have a lot of clauses, you have shareholder agreement, you have a lot of other documents. And then the third reason would be that it's more cheaper. So the CLA compared with equity rounds in terms of paying lawyers and everything, it's more cheaper and safe. Probably we'll be discussing later on Gautam. Safe is more used in the States. It was basically discovered or put in the market by Y Combinator, which is the biggest accelerator in the world. And basically, there is very easy in a few days, you can just sign the safe and have the money in your current account.
Okay, so we can get with it. Now, one thing to remember from those two examples is the fact that they are taking into account one convertible converting. Okay, if you have multiple convertibles, then especially the price based on valuation cap, where it says 5 million cap, the conversion, this is the second part, okay? $2.50, which is 5 multiplied by 5 million by 10 million, you're dividing the valuation cap like that. That will not work, especially when you have multiple convertibles. So if Robert, you go back, I'll just show you in the formulas. Just go back on the formula, yeah. So when you look at this formula, just look on the left side, the pre-money convertible. You have valuation cap price per share, and discount price per share, and conversion price per share. So a convertible note basically gives an investor multiple scenarios or multiple ways to choose which price per share the investor wants, and the investor wants the lowest. So price per share for equity is what the equity investor is paying, okay? Now, if the convertible had a valuation cap, then valuation cap price per shares will be calculated, which will be calculated by, this is one method, but the investor can have, let's say that this can include also future option pool shares as well, right? So this will be again written in the capitalization section. So valuation cap price per share will be calculated for each convertible as their valuation cap divided by the fully diluted shares accounting for before that round takes place, which is like your common stock, outstanding options, and unissued options. Now, if there is a discount, so this will be price per share equity, you're basically discounting it by whatever is the discount percent, like 20%, 30%, and so on. Then this conversion would be minimum of these two. And in a good scenario, valuation cap will be, this price per share will be lower than the price per share for equity, right? So you should convert on the conversion price. You choose from these three: price per share from equity, valuation cap, and discount, whichever is the lowest, okay? Now, if you have a convertible with just valuation cap, then there is no discount. There's just two price per shares. If it's just discount, then there is price per equity and discount. And you know that this will always be lower than price per share for equity because you are discounting it, okay? So this is why I would say one convertible, you can use that formula, but if you have multiple, then you have to use this approach. Okay, let's go. Now, simple agreement for future equity or SAFE. Now, the SAFE was created by Y Combinator back in 2013. Another a big accelerator known as 500 Startups. They created something similar to SAFE known as Keep It Simple Security, or KISS. Okay, and everyone knows the infamous Dave McClure from 500 Startups. So he was the one who came up with this. And basically, what the SAFE achieves is even more cheaper way of financing a company and a faster way of financing super early stage companies. And legally, it was a way for Y Combinator as an accelerator to get equity of a company. Because when you think about this, that legally speaking, if you are accelerating a company and you say, well, if we are doing so much, we should get some equity of the company, right? But getting that services for equity was really difficult. You would end up getting options get taxed, and so on. So Y Combinator basically came up with the idea, what if we give them something, like 100K if we give them and we get an equity out of it. So when money is getting exchanged, now that becomes a transaction. So that became the accelerator model, that they are going to invest a little portion and get some equity because they are accelerating and so on. So Y Combinator came up with this idea known as the SAFE, or the Simple Agreement for Future Equity, in 2013. Now, this was known as the first version of SAFE, and this was known as a pre-money SAFE. It had a lot of problems. So the SAFE was then updated to post-money SAFE in 2018. And since 2018, I would say about 80% or 85%, given any quarter of the SAFE transactions, they are post-money. So pre-money is still around a bit, but mostly all of the transactions are post-money SAFE. Okay, now what was the problem? So when it comes to SAFE, just like a convertible, investors do not get into a cap table, okay, but it's not a loan. So the number of shares an investor will get is going to depend on the type of the SAFE and the next equity round valuation. Okay, so if you had a post-money SAFE, I'm investing right now, let's say 500,000 on a 5 million valuation cap. So 500K, 5 million, 10% I have immediately in the head, even though I'm not on the cap table, but in my mind, okay, 10% of the company is gone. And this concept is important to know, because founders make a mistake. They continue raising money via convertibles. They don't know how much equity they have already given away. Because you do 500K on 5 million, 10% is gone. You do another, let's say 250K on 5 million, you're giving away more and more and more. So this is why whenever you're raising, always have a cap table modeling scenarios in your cap table. Like, this is what it looks like if I raise this much at this, let's say valuation cap and discount. This is what my cap table will look like if I assume my next round valuation would be like this or like that. Okay, SAFE is not a debt, so there is no interest rate with a SAFE. Okay, but a big problem with SAFE, both pre-money and post-money, is if there is no equity round, SAFE will not convert. Investors are in the limbo. So this is why in Europe, a lot of European investors are more risk averse. They would usually opt for a 0% convertible loan agreement. So they don't come into this scenario that no equity round is raised and they are just left in the limbo. Okay. Now, this is also another reason that SAFE is used for early stage transactions like pre-seed, seed, and so on. Series B, C, you are not going to see SAFE because of this specific reason. Because in later stages, depending on how company is doing, how market is doing, and companies' equity becomes more expensive, and you have access to venture debt because you're making money, right? So you can take a loan of, let's say, 20, 30 million for a period of 3 years because you have cash flow coming in. So why would you give away equity, which is expensive? So anyone who had done safe, they would be just left in a limbo, right? Now, just like a convertible, there is no set time frame. So you can just go back, Robert. There's no set time frame. So if you're raising, let's say 200,000, you get someone paying you 10,000, you can just take in the money, sign the safe, get them in, and so on, right? And safe investors, so this is again very US specific, the class of share a safe investor gets, So a Series A investor gets, let's say, a Series A1 share, and this is what we have in US called a shadow series, like A1, A2, A3, and I think in different jurisdictions you can have a different class. So it's like the same series, but any equity investor will have a preference. So whenever a company gets sold and there is a distribution waterfall, right? So whoever is, let's say, a Series B investor gets their first cut. So Series B's equity investor will have a seniority over a convertible or a safe investor. Okay. So let's go to the next one and let's look at the elements, which are very similar. So this is, again, the idea is lower price per share, right? So just like convertible, there is a principal, there is no maturity value, right? Because the principal will get converted. You have a valuation cap, the same thing as a convertible. You have a discount percentage. Again, here it's also 20%, and a most favored nation in a safe as well. And this was more applicable for a safe because a company would raise their first money from friends and family, and they don't know about valuation cap or anything. You just say, okay, we give you most favored nation. That's it done. Okay. Let's go to the next one. So I have like 4 cases over here. So if you're raising, let's say 500,000 with a valuation cap of 5 million, and approximately 10% of the company is gone at that moment. So future equity round we'll see, but 10% is the starting point. So if I don't put in additional money later on in the equity round, I will go down from 10 to, let's say, 6% or anything, depending on the valuation. But right now, as an investor, at least I can say my starting point is 10% because of this valuation cap. Now, the second case, this I call it, a lot of VCs also talk about this, but this is a bit erroneous. Because when they say a company raises 500,000 with a 20% discount on valuation, not discount on price per share, but discount on valuation. So you're basically saying valuation cap of the next round. So you're basically taking whatever is the next round valuation, you're deducting it by 20%. So in a way, you're talking about valuation cap, not discount, because discount is always on a price per share. Okay. So some investor, if they say valuation cap and then they have a 20% discount on valuation cap, it's not exactly discount. It's like you're having 2 valuation caps in a way. So the third case, that's where a company is doing a 20% discount and the price per share is $10. That's a proper discount. So you will be basically discounting this $10 per share by 20% to get your price per share. Okay. And the case 4 is most favored nation. I've already explained it. So, the early investor will basically get. Now, talking about pre-money, post-money safe. Okay. So this is same thing when someone says 500,000 on a 4.5 million pre-money. This means post-money is 4.5 plus 500K. And in a post-money safe, when you say 500 on a 5 million, that is the post-money. The biggest problem with the pre-money safe lies in the valuation cap price per share. When you see that future option pool in the denominator. So an investor could not even calculate whether they start with 10%, 8% or whatever, because they have to factor in future option pool allocation. You don't know whatever it will be, 10%, 15%, what will be the negotiation in the future, let's say 24 months from now with any lead investor. So that was a big problem that the investor just didn't know. Another problem was that the multiple safes. So if you have raised, let's say 2-3 different safes with different valuation cap, when they will convert, the safe investors will dilute each other. Then another problem was if you have an option pool, then it would dilute the founders. Okay, so safe investors don't bear the dilution, so it's not good for the founders. And lastly, there is a right known as pro rata right. So this is a right to invest in the next round to maintain your equity ownership. Because if I, let's say, start off with 10%, I'm just saying that's an equity investor, and I don't put in more money, I will of course get diluted. But here, the pro rata rights would be to the second subsequent round. So if I invest, let's say, seed as a safe investor, in Series A, I can't put in more money, but in Series B, I can put in more money. But that doesn't make sense because let's say Series B valuation will be much bigger than Series A valuation. So I will get washed out because of my equity, right? And I would probably not have enough money to even maintain my equity. So these were big problems with pre-money. So the post-money safe solved all of that. First thing it did was the safe investors will get pro rata rights for the next round. And this is done via something known as a side letter. Side letter, think of it like a side agreement. So you sign the safe documents, plus you say, here's a side letter, related to this investment, which the investor is doing, that this investor gets pro rata rights to invest in the next round. Okay. Valuation cap, price per share, this was fixed. So the safe shares were put in the denominators. So this is what you have to calculate, and this is a circular reference. Now, when you do that, you actually make sure that the safe investors do not dilute each other. Okay, so that dilution is gone now. Now, of course, a new option pool, when it will get created, it will dilute the safe investors as well. So it becomes a bit founder friendly when you are having a post money safe. Okay. And of course, starting off, as an investor, if you're doing 500K, 5 million, 10% you are starting off with. Okay. Let's go to the next one where I have, I think, an example. Yeah. So this is an example I have thrown where a company has raised via two safe investors, safe one, safe two, same money, 500K, 500K. Okay. And you have a seed investor who would get 20%, right? So this investor is not going to get diluted. Now, if you look at pre-money, and there is no option pool here, okay? So if you look at the pre-money safe, here you can see that the investors are getting 3.64, 3.64. They diluted each other. And when you look at the post-money safe, it's 4%, 4%. So 8% for the safe investors. So they are not basically diluting each other. Now, in the same example, here we have no option pool, but let me throw in an option pool. Robert, you can go to the next slide. So same example, but now I threw in a 10% option pool pre-money basis, okay, which is the standard. So here you see that now they're still at like 3.64, 3.64, 10% here. So this means the founders are getting diluted. And on the right side, you see it's 7% now. So they started off with 4 and 4, 8%. Now they're down to 3.5, 3.5. And so this option pool, it's basically everyone is getting diluted until the safe investor, besides the new equity round investor. So this shows you basically the different characteristics between pre and post money. Nowadays, mostly post money safe is used. You can go to the next one. So safe can have multiple flavors. I call it like flavors of safe. So you can have a pre-money safe, just a valuation cap, pre-money safe, just a discount, pre-money safe with both valuation cap and discount, or you can have an uncapped safe, super risky for an investor. And uncapped safe will be used only when, let's say you're raising an equity round, you're running out of cash. And the lead investor says, okay, if you need cash, let me give you just immediately, let's sign a safe. I give you a portion of my money. So if I'm a lead investor investing 500K on a 1 million round, and you say, I need cash. So I would say, okay, from this 500K, let me give you 200K, right? And I give you 200K, and this 200K is going to convert, but I know it's going to just convert in a matter of months, and I'm setting the valuation. So that's when I say, okay, uncapped safe I'm doing, but it just gets converted, and I will say it will get the same equity class of share, which I would be getting. So it's just I'm accelerating in a way. It can be also a good way that you can do a convertible loan agreement where you can say, okay, we need the cash. And if you have that negotiation, if you are in that scenario, then you can do something like an uncapped security. And you have the most favored nation. Okay, just with most favored nation. So similarly, you can have pre-money, these 5 ones, and then you can have post-money, just valuation cap, just discount, both valuation cap and discount, uncapped or most favored nation. Okay, so even with convertible, there is many combinations you can do. Let's go to the next one. Okay.
And so, let's try to make a short exercise to see whether the participants in here remember at least the 3 types of investments that can be done. So I'm just curious if you can say what are those 3 types.
Just write it down in the chat.
Or just say directly.
To be sincere,
just making sure you're not sleeping.
I'm trying to. It is a big mix, and I'm just trying to catch up. To be sincere, so.
Okay.
I need time to.
You have the conversion methods, option pool, pre-money, post-money, basically, and convertible notes.
And safe.
And safe, yeah. And
Yeah,
safe.
so you have three: equity, convertible note, and safe.
Yeah.
Okay, so these are the three instruments, and within those instruments, you have different ways of how you can structure them, how you can convert them. Okay, so Robert, let me just share my screen. So I want to show them something.
Yeah, sure.
Okay, so we will be now moving towards basically terms of an investment. Okay, so I will show you what a term sheet looks like. So everyone can see my screen. Let me see, it's loading.
Yes.
Yeah.
Okay, so this is a very, it's a model term sheet, but even in Europe, you will have different ways on how it is structured. Okay, so your term sheet is basically going to look like this. You know, this is a term sheet for this company and so on, laws of whichever country and so on. So the term sheet will be divided into different sections. You will basically have offering terms like what's the closing date, who is the investor, amount raised, as I said, the price per share, which will be written over here. And usually the design is like this. It will be, you know, the terms in the left and then on the right. Design can differ, but content is going to be mostly same, and it can be arranged in a different way. Okay, so some of them will arrange, let's say 2-3 sections here into one section. Then here's your pre-money valuation, right? Capitalization, then dividends, liquidation preference, voting right, protective provision, okay, optional conversion, anti-dilution. Then here's your stock purchase agreement. Now, all of this in a term sheet, you know, you have these different sections like investor rights agreement, stock purchase agreement, and so on. So what's going to happen is that when the actual equity round is going to be executed, there will be a 50-page stock purchase agreement, okay, which is basically, this term sheet is the basis for all of that. So whatever is written over here, it just gets expanded into that 50-page. You can even go to the website of British Venture Capital Association, PVCA, and they have model documents on how these are structured. Now, depending on different jurisdictions, it's same. Like Albania, probably it would be in your language, and there would be these different aspects, okay? So this is very long, and as you can see, usually a term sheet can be somewhere between 15 to 20 pages long, and there are some annexures in the end. So there's like Exhibit A, pre and post financing cap table. But this is very important, like always make it. And if you are going to have any option plan, you know, like you are going to have 5-10 people, so then you will probably have another one like Exhibit B, where you would say, okay, these are the people who would be hired on option plan. This is how the option is going to get split. Or if any other exhibit the investor needs for this. Or if there is a information rights, we are going to talk about that. So different investors, you should give them different information rights. So basically, this is how a term sheet looks like. Okay, I can send it to you. You can take a look. It's just that sometimes like this voting agreement here, board of directors, maybe it will be just on top and there will not be any division that, for instance, this is divided into investor rights, stock purchase agreement. Let's say you will have everything just put together, right? But the content, that's going to be extremely similar. Okay, so this is what a term sheet looks like. I'll send it to you guys as well. Now we can go back to the presentation.
I'm just curious how many of you heard before about the term sheet and what do you believe it's a term sheet? Because we went directly to the clauses.
First time I hear the term sheet, to be honest.
Yeah,
First time, okay.
me too. First time. I mean, separate sections of it, or some of the elements. Of
Oh, but we
course,
will
the
cover everything.
dividends and everything, but as
Yeah.
in a whole document, it's first time.
Okay, so
And pro rata.
okay.
So the pro rata, I've only heard it in a mineral transaction when you do
Okay.
the total price divided by the quality. It's
Okay.
called the pro rata rights.
Okay. So we will cover most of the important terms because there are some terms which are super standard. You know, you can't negotiate because that's just a standard. So what you can negotiate, I will tell you. So a term sheet is, what's important to know, it's a non-binding document. So even when you sign a term sheet, if things don't go your way, if the investor is flaking, you don't have an obligation to convert it into actually a, let's say, stock purchase agreement and execute on the shares. Now, I have seen some cases where deals fall through. Even in Romania, I remember a transaction where the founder changed the terms in a span of 3 weeks, where he said, okay, now the valuation goes up. You invest the same, but you get less. And we're like, why? Like, we are not going to do the deal. Like, in 3 weeks, what happened? Did you get any new contract? How did the valuation suddenly jump, right? So that's where the term sheet, even though it was signed, it just didn't, it was not executed. Okay, so it's a non-binding document. Just because you signed it with some investor, again, you have to get all the investors lined up. But if you are not going to honor it, or if something happens, you can change it as well. Now, what can also happen is that in a term sheet, let's say you wanted to get 2 million, but you found so many investors, they want to invest now 2.2 million. So you talk to the lead investor and say, okay, there's not 2.2. What should we do? What are you interested in? Should we give away a little bit less, let's say a little bit more equity, more money is coming in, it's good. So you can negotiate and the terms can be changed at that point, okay? Or if you're raising money in parts. So if you're raising 3 million, but you know that if I go out in the market for 3 million, it will be really difficult. So you set the terms that 3 million for 20%, which means 1.5 million for 10%. So you raise 1.5 million first for that 10%. And then after some time, you prove your traction, you are still in that fundraising process. This is also another way things are done, okay? And it basically outlines the terms of an investment, which an investor wants, like what protection they want and what rights they want from when they are investing in your company, okay? So it outlines all of that. And then it basically becomes expanded version from the different sections, as I said, to right of first refusal, co-sale, drag along, investor rights agreement, stock purchase agreement, voting matters, and so on. Okay, so it's all the conditions before the final agreement will be signed and it will get executed. So that is known as the terms of the investment. That's what term sheet is. Okay, simply put. Let's go to the next one. Okay, so this is
mentioned.
Yeah, basically it's a framework of negotiation. You can always negotiate a term sheet. If investor sends you a term sheet, they have prepared in a way. Now, in terms of components, this is how I divide a term sheet into different components. You're going to have an offering terms related to the charter of the company. So this will be mostly dividends, registration, all those kind of things. Stock purchase agreement, because they are going to buy a stock of your company. So the agreement on the stock purchase, the conditions of the stock purchase, the treatment of the stock in the future, okay? Investor rights agreement, as the name suggests, what rights an investor gets when they are investing in your company. Next, we will discuss this right of first refusal and co-sale agreement. So this is usually US, it's bound together, it's tagged together, but in European term sheets, you will have right of first refusal. Then you're going to have another section just below it or somewhere else called co-sale agreement or tag along agreement, okay? And then voting agreement, so what voting rights they get, okay? And lastly, some other matters, and we'll discuss some other matters as well. So let's go. So offering terms, this is basically starting off with a closing date. So meaning how long basically it's going to take to close this. So from the date of signing, usually it can be something like 60, 90, 120 days, or the language would be written, or as soon as possible, conditioned upon completion of legal and financial due diligence. So this lead investor is basically preparing your term sheet. So when a term sheet will be presented, let's say they have done 70% of their due diligence, but there's still the legal and financial due diligence that needs to be done. So for that legal due diligence, there is a section, I'll tell you what the lawyers will be looking at. But let's say you are very close to getting an investment. So that's why they would write as soon as possible, condition upon completion, right? So they don't want to put in a date at that time, or if things are like the investor knows who else will be participating, then they would just say, okay, 60 days, we are going to execute upon it, okay? So investors, lead investor would say, okay, this is the legal name. For example, ABC Ventures Fund 2LP is the lead investor, will be investing X amount or Y amount and so on. So amount raised, it would be the total amount raised. So it would be written that for a seed preferred stock, amount raised will be about 2 million round, and the division would be ABC Ventures Fund 2 would be investing 1 million out of this 2 million. And if it's any co-investor, then they would say, okay, we are investing 500K on this round, which is 2 million, and so on. Then pre-money valuation and price per share. So this is where it would be written, what's the pre-money valuation and what's the price per share, okay? And the capitalization section, as I showed you, so that's where it would talk about what's the fully diluted shares before this investment is going to take place, okay? So the investor has probably done a cap table modeling, and it can state if there is any convertible. So if there is any convertible, then it would say, additionally, this much amount of money will also be converted from the prior, let's say, amount which was raised. Okay. Let's go to the next one. Yes, so now we come to the next section, which will be the dividend section, right? So there are three ways in which this can be structured. The most usual way is it will be paid on converted basis, okay? And it's like in the future, like whenever the company decides to pay, it will not be cumulative or non-cumulative. Again, this will be changed if you are a lifestyle kind of a business and the investor wants dividend, then they would say, okay, after these many years, when a company gets to this threshold, then the dividends will be distributed. Okay, but for high growth companies, it will be paid on as converted basis. Next is liquidation preference. So we will spend a lot of time actually on liquidation preference, but I'll give you just a quick overview. So this is where an investor during a liquidity event meaning IPO, M&A, acquisition, bankruptcy, and so on. So when a liquidity event is happening, liquidation preference will give the right, not the obligation, for an investor to utilize the way they structure the liquidation preference to get their first cut before the common shareholders or before the founders can take their cut. Okay. So first, of course, whenever liquidation event happens, first the debtors, creditors, you have to pay all the debt. Then whatever is left based on this preference, the investor is going to decide. Okay. Voting rights would be like, what are the matters on which investors can vote? So this can be things like if the company wants to take a big loan, if the company wants to, let's say, buy another company, so those kind of things, changing the business line and so on, very general. Okay. Protective provisions. So this is again, certain provisions to protect the investors. So if you want to sell, let's say, your preferred stock to any other investor, like you have to inform them. If you want to take on debt, again, issue a different class of stock, take in a lot of debt and so on. So that's all protective provisions, very general, So this is not something which you will negotiate. Liquidation preference, you can negotiate. Industry standard is 1x non-participating. Now, in some jurisdictions, it can be 1x participating. Now, what is participating, non-participating? We will cover that. And anti-dilution. So anti-dilution basically means that if a company in a scenario raises more money at a valuation lower than the valuation of the previous round. So as Robert had given an example, you raise at 10 million, but the next round is 8 million. So for an existing investor, this is bad because I get diluted, right? Someone comes in at a lower valuation and my shares have decreased, my ownership has decreased. So this is where an anti-dilution provision comes in, where it would be written that the investor in a situation where a dilution event is happening, their ownership will be preserved. How it will be preserved? There are three methods, okay? The most draconian method, which is not used, is known as a full ratchet method, where you basically, there are two ways that you can either change the price per share for that investor at which the shares were issued, or what you can do is you can issue more shares, but it's always better to change the price per share rather than issuing more shares because that increases legal cost. You have to consult with lawyers and so on. The other is a weighted average method. So this is where the shares will be retained. And another one is just similar, like broad-based weighted average. Okay, it's actually written in the model term sheet. When you go to anti-dilution, there's a formula which is given, like CP2 equal to CP1 multiplied by A plus B, A plus C. And that's basically the price per share of the last round, the shares which were issued, the shares which are issued now, and so on. So it's basically a weighted method. Next, let's go to the next one. Yes. So mandatory conversion. So basically in a liquidity event or when company is going public, the preferred shares can convert into...
Gautam. Okay, the anti-dilution method, but aren't there just non-dilutable shares?
Non-dilutable shares?
Yes. Like you buy 5% of a company, but you agree that they are not dilutable. So whatever
Not,
other rounds, other seeds, other money you take in the future, for sure I will have 5%. They are called non-dilutable shares.
that will be very strange because I have not come across something like that. Because if you're not investing, new person is coming in, like you will get diluted. Now, if that kind
No,
of
you just have an agreement in the beginning that for this amount of money I will have non-dilutable shares. That's it.
but later on, this person can get diluted or will never get diluted.
Never diluted. 5%, 5%. I'll non
That's a very good deal for that investor. That's a super good deal for the investor, but that's not a deal I would say you should sign up. Usually what I have seen is fixed percentage conversion, as I said, for any early investor or accelerator, but non-dilution, that will actually make things difficult for you, because if someone actually is going to be fixed on 10%, will never get diluted, then any new
Yes.
investor coming in would just say, okay, why should I not get that? And if you give them that thing, and that's so precious for them, then they start negotiating, oh, we will not invest. So same thing with
No,
liquidation.
I just know that there exist non-dilutable shares. That's it.
Okay. So if there
And
exists, then investors would usually, they would not take something like that, because that also creates a precedence, right? So
no, the
anything.
idea is that if for example, like pre-money evaluation, etc., like I'm considering that my company valued to 10 million euros. So if you want to buy 10% of it for 1 million euro, I say to you, okay, for 1 million euro, I'll give you 3% non-dilutable shares. Not anymore 10, because the investor will think, okay, in the future, when he will raise more money, more rounds, and it will grow up, my 3% will be much higher. So it is just a way to you can do 10% dilutable or 3% non-dilutable for 1 million euros. You see my point? And the investor knows that, okay, 3% means it's great for me because in the future it will be much higher than the previous 10% that I'll get diluted every time.
So if it's a small amount, then it will make sense in negotiation. If it's a
Yes,
small
yes,
amount.
we're always talking about small amounts, like 10% dilutable or 3%, 2.5 or 4% non-dilutable shares.
It will be interesting though that how the later round investors look at this, right? Because if the pie starts getting smaller and someone is not getting diluted, then there can be some tough negotiations, or that person will be forced to give that up, and it will have to be changed into, let's say, dilutable shares, because anyone else who gets it, it's like a preferential treatment someone gets, right? So, you can think about that, but you have to be careful on how you structure it. Because I will
No,
say, when it comes to liquidation preference, if you give 2x, for example, liquidation preference in a seed round, Series A would say, hey, I also want 2x, because you gave 2x to them, right? And then the other one, if they come in, they would say, hey, you gave them 2x, I also want 2x, right? So that's why whenever you're raising the first round, you have to be very careful on how you negotiate, because that sets a precedence. Whenever you raise money via safe or convertible, whatever was your valuation cap will become the starting point of your valuation discussion with an equity round investor. Like I will ask, okay, did you raise money via safe or convertible? Same way. Okay, so I was talking about precedence. Yeah, coming back to the charter. So preferred stock, if it exists, there should be a right for it to get mandatory converted into common stock when everyone is going to sell their stock, when a company is going public. Okay. With regards to anti-dilution and pro rata basis, there is also a provision at times called pay to play. Now, this can have a positive or negative effect depending on how it is exercised. Okay. So if there is a down round happening, right, and the majority of investors are approving, so what can happen is that if you are not going to invest, because some investors would say, oh, this is like a down round, we didn't like it, so we are ready to get diluted, right? Now, anti-dilution provision will not get triggered if they don't pay. So if they just want to get diluted, then they will not get anti-dilution. So that's what's known as a pay to play. Like you have to pay to place that anti-dilution. So all other existing investors, if they are not paying, one of the majority is paying. So then that majority gets anti-dilution rights. So their ownership is going to basically increase or stay the same, but depending on whatever it is, full ratchet or broad-based average method, whatever it is, right? But for the others, they didn't pay, so they don't get anti-dilution and they are going to get super diluted, or maybe at times they don't even get pro rata for the other rounds. That let's say the next round is going to be great. Now you want to put in money, you can't. You have to get even more diluted because you didn't pay in the last down round. You lost faith in the company, but I didn't lose faith in the company. So that's why you don't get anti-dilution or pro rata rights. Okay. Redemption rights, also known as a put option. I would say in some European term sheets, you would find it like a put option. So this is where if a company is dying, at least the investor should get the right that they can put it to rest, dying company, and just exit out, sell back their shares to the company, any other investor, and like Tata, bye-bye, I am going, right? Conversion, this will specify what will be when a preferred stock converts into a common stock in any liquidation event. So what will be the ratio? Standard 1:1. If it's more than that, then imagine in a liquidation event, if someone had 100,000 shares and now can get 1:2, can get more shares. So they are going to get more return on their investment because now their ownership increases when the conversion happens. So the standard is usually 1:1. Some, let's say, founders I have seen make mistakes where they had it more than 1:1, 1:2, or 1:3. So you should always have like 1:1 conversion ratio. Let's go to the next one. Okay. So with regards to investor rights, what kind of rights investors get? So registration rights is mostly when an IPO event is going to happen. So you don't have to concern about this. So this is going to be a time that the preferred stock can be considered a registrable security. So registrable security is basically all the securities which are offered during a public event, so that exit event. So that investor basically wants to make sure that if an IPO event, I don't get lost out because of it. So I will have those registration rights for an IPO. And with this, there is also some other rights, like there is a lockup period termination only for IPO expenses and so on. So that's all concerned with the IPO event. So that's again, everything under registration rights, 5, 6, 7 sections. Board composition. So this states what the board composition is going to be. And here I have data from Omni, which shows you at different stages, what's usually like typical board structures when you have. So typically when you're, let's say, raising equity capital for the first time, the managing partner of a fund who is taking the lead will take a board seat. One will be management and maybe one from independent and so on. Okay. So you usually have like 3 people in board. Now, there can be an observer seat. So observer doesn't have any execution powers like the board person. So any associate or a principal who's helping the partner who's leading your deal of the fund can say that, okay, I need like 1 observer seat for this associate. So basically a training for them. And in certain cases, what can happen is that if there is a second investor in the same round, who's the second biggest majority, okay, so they can say that, okay, I want observer seat too. So then you can have observer seats. But this one is basically showing you the board composition, okay. Board matters section, again, very general. It will basically talk about, director, officer, liability, insurance, those kind of things. When will the board meetings be conducted? Will it be monthly? Will it be quarterly? Right? What will be, let's say, how it should be prepared and so on, anything like that. So very general stuff again. Investor director approval. So this is again, the lead investor, that partner, what will become the investor director. So again, taking a board seat. So what are the matters where you need an approval from this person, right? So if you want to, let's say, buy a company, again, raising debt, let's say you want to fire someone who is a high-level executive, a co-founder, and so on, right? So those kind of things, again, very general. Let's go to the next one. Yeah. Now, this is important one. So drag along rights, okay? Now, as the name suggests, drag along. So in an event where the company wants to get acquired, and let's say there is a buyer, right? Now, all the majority investors agree that let's sell the company. But let's say one minority investor says, no, I don't want to sell. and the deal doesn't go through if there is no drag along rights. So if there is a drag along right, all the majority is agreeing, let's say one minority is not agreeing, they drag along this person to execute on this deal. So that's what's known as a drag along right. Okay. Next, you have ROFR, co-sale, and tag along. Now, drag along right are balanced by tag along right. Okay. So in a drag along right, the majority is basically dragging the minority that we should just go for it. But let's say there is also an event where all the majority shareholders can sell their shares, but the minority can be left out. So in such a situation, the minority can tag along with the majority, stating that, hey, I also want to sell my shares. That if let's say a buyer says, I want to buy 51% of the company, some founders and some investors majority say, okay, total will be 51%, you can do that. And this minority will be left out in that 49%. Right. So now the minority can say, hey, I want to tag along. I also want to sell my shares proportionate to how you guys are selling. Right. And I want to exit out. That's what's known as tag along. That's why when you have a drag along, there will be tag along. It's like a balancing act. Now, right of first refusal or co-sale agreement. So whenever a company has raised money, has investors already on the cap table, you can get an offer from a third party investor saying, hey, I want to buy a percentage of your shares. Now think from a perspective that founders own 80% of a company, investors own 20%. Now an investor comes in and says, I can give you 500K if you sell me your portion of shares, like 20%. So the founder can sell from 80 to, let's say, go down to 60%.
I lost the voice of Gautam. Only me or?
Yeah, probably lost the signal a bit.
Everyone.
Yeah, probably too much information, and then the slide said, okay, we need to stop a bit. Yeah, let's wait for
I mean, since you're waiting, maybe a question. So far I've had the chance to only have a discussion only with one investor, right? A potential investor. His feedback was, let's see the first couple of years how your startup will actually go, and then we talk about investing. Now, what we're talking about right now is also early investment. I mean, when do you think is the best time to approach an investor? Because that got me scared. Like the thing that I was trying to do was to actually generate revenue. So basically, that's what investors would like to see, like how much money have you earned with your startup. But most startups don't have the money to build their product to begin with, right? So that's the question there.
Yeah, I completely get it. So in my perspective, you should be discussing with the investors even before you have the idea. So because what is happening is that they have access to a lot of, resources. They know very well the market. They have different connections, and they know very good lot of industries. So basically, it's we've been discussing also on the first workshop. It's that process in the lean startup, which is build, measure, learn. So basically, you should try to do this with the investors. So basically, if you have an idea, let's take an example, and you want to raise some money, you go to an event and you meet an investor and you say to him, okay, I have this idea. What do you think? And then you can stay in touch with him, try to find some information from his side, some insights about the market. Maybe he knows some companies that are active in that specific industry. And then you can try to make some benchmark to see their business models, to see where they are scaling up their operations, whatever might be relevant for you. And then along the way, as you build a company, then you should keep them under the loop, meaning that you should send them kind of updates, I don't know, monthly or quarterly newsletters with the status that you're having. Hey, right now we are building the MVP. We are in discussions with 10 customers. We do have the validation. We have some early adopters. And then as soon as you are getting close to the fundraising round, they can see that you already done some steps. You are committed to your startup. You have some metrics, and then you can have a more concrete discussion. So basically, I highly recommend to discuss kind of, being your partner, your peer, and try to find out some information about the industry that you want to build something, because they are very well connected. So this would be my 2 cents in a nutshell.
All right,
Rob,
thanks.
Robert, an unfair question to you. Up to now, maybe you have seen our pitch decks or whatever. Would you invest on our companies? Or what is your take on that's the question. Do you think they are investable or attractable at most?
I'll be very honest, it's almost impossible to tell you whether this might be investable or not. Let's take a very easy example. In our programs, we are staying with the startups around 3 months. During those 3 months, we can assess their progress. We can see how they habit. We can see if they are coachable. We are discussing with different mentors, either investors, either experts in various industries, and gather the feedback. What do you think about this team? How do they behave? We give them some KPIs at the very beginning of the program to monitorize them. And then after 3 months, we can say, okay, this team might be a good fit for a potential investment. Either ways, it's a bit difficult. And usually, let's take a real example. The investors, usually the VC funds, um, spend around 3 to 6 months to take a decision about the investment. So you can imagine this might be applies to us as well. So I cannot give you right now a real.
No, I'm not saying that. Okay, go give the money, etc. Do you think there are things where you find there is some value?
Well, yeah, as I said, it's difficult. I mean, I'm also an angel investor, and those two companies that I invested were companies that I followed. One of them for 1.5 years, and the second one for at least 6 months. And I asked to them a lot of questions, meeting them to various conferences, events. They've been part of our programs. We have access to various data room with all kind of information, financial analysis, market research, data about the team, projections, go-to-market strategy. So at that time, it was easier for me to make a smart decision. But I cannot give you a real answer right now. I'm trying to be very honest. If I say yes,
Yes.
maybe you say, oh, this is good. If I say no, maybe it's bad. So I rather prefer to see your progress after the accelerator, to see whether you accomplish some KPIs and then stay in touch. And then I can say, okay, you are on a good path or not.
Yes, that's why I said it was a trick question from the beginning.
Yeah. I truly understand.
I was just trying to extract information.
Yeah, this is why I give you so much information, because I am pretty sure you can gather something from here.
Okay, I see your point.
Maybe to answer from a different point of view, and I will finish with that. If you have a close person, if you have kind of business angel around you that knows you for a few years, that have access to your track record, that know exactly what you are building, so probably for that person would be more easier to invest in your startup. But for me, seeing you third time, not knowing you all the information about what you're building, we need to build that trust among us in order to keep having discussions. And I'll be very honest, and this is my last point. Working with so many startups from our side as an accelerator, we usually were very, happy and always recommend the startups that we were having in the programs to the investors, until one day when an investor asked me, okay, Robert, you have a lot of companies in your portfolio, great companies. In how many of those companies would you invest? And at that time, for me, it was kind of, okay, this is a very easy question, but in the same time, it's difficult to be in the shoes of an investor and try to see, okay, if I invest 10K in you, in your company, would your company be able to give me back in 3 years, I don't know, 3x or 5x or 10x for an angel investor? And having this in mind, being in the shoes of an investor, the entire image would change. And try to do this exercise. Try to be an angel investor for another company or for yourself, and see with not with your co-founder eyes, but with the investor eyes, to make all the projections and try to imagine if your company will be able to give you the money that you're looking for. And then you'll have a different mindset in a way.
Actually, when I made a pitch for an event that had different stages, and I was up to the pre-ultimate stage, somebody asked me this question: when do I have my money back? And I told him from the company, never, because we want to spend, like Gautam said, when Microsoft gave back some dividends, paid back some dividends, the price dropped, meaning that we would spend the money, everything to fuel the growth year by year. So we wouldn't give back any dividends at all, just because we don't try to bleed out of cash, but we want to grow fast. So if somebody wants to take back his money, if I can make the company 10 times more valuable, he can sell his shares and he can recoup whatever investment he made. And but that's the mindset when you try to, when you want, or when you really think that you want to grow fast. Like the last thing that I think is paying dividends out. And if I don't do that, it means that I'm doing a good job. Always, if I'm growing the company, if I'm whatever profit, and for sure we're trying to work to make profit. Whatever profit it is still used the next year just to fuel the company and to make it grow faster. So the question, what is my ROI? I don't think it's always good when somebody has an answer that says, okay, in 3 years or in 5 years, I'll pay your full $500,000 back. It means that in the next 5 years, he will for sure take away $500,000 of company's money to give as a dividend and not use it to fuel growth.
Well, what you need to understand is, discussing about startups, usually the startups are not, profitable after, I don't know, 5 years or 7 years. And I'll give you a very simple example. UiPath, which is the first Romanian unicorn that was listed at New York Stock Exchange in 2021, I don't believe that even now, after 10 years, it is profitable. So when you are entering into the startup world and you are an investor, then you don't need to look to the dividends or to ROI or whatever. You are looking to different metrics that for you are relevant in terms of, potential exit. If I buy this shares at this price, then probably after 5 or 7 years, I will think to potential M&A, or maybe these companies might be able to get listed on the stock exchange. When I hear companies or startups discussing about profits or different terms that are related to the profitability of the company, here might be a mistake, because usually this is happening very, very late. And what we need to have in mind also is that even though we are discussing about investments in here, this doesn't mean that this is the only path for you guys. I mean, the cheapest money are, the money from the clients, from the customers. So there are big companies in the world. If I'm not mistaken, Mailchimp is one of them that grew and is valued to billions of dollars without any, investments from the investors. Meaning that you need to focus rather on building the company instead of building to raise an investment. So basically, they should go in line a bit. This is my 2 cents as well.
Thank you.
And maybe we should go to the presentation now, and then at the end we can have another few minutes for the Q&A.
Sure.
Okay, so we were at ROFR, and I think I had explained right of first refusal mostly. And just the other one, option pool, is simply where it will be written how much option pool is to be created, And information rights. So as Robert has stated, lead investor will want more information rights about the performance of your company. It can be monthly updates, maybe weekly small updates, and they give you usually a format of how you have to report. Okay. They would definitely want to see your audited annual financial statements, unaudited quarterly, and so on, like that. Now, when it comes to super minority investors or minority investors, you should always restrict the information rights. So they should not get weekly updates and so on. Now, the reason being is that let's say you have some angel investor investing, owning 0.05% of your company, right? You don't know what that person is doing. Maybe that person is advising your competitor. They're getting cash for that. And if you send all your metrics, your reports, like this is a customer we got, this is what we did, that information can be passed on, right? So that's why for super minority investors, you can just have, usually the lead investor will tell you what sort of information they are comfortable giving away. It would be just, let's say, the financial statements at the end of the year. That's it. And no other information rights, right? Only you can give them that if you have done, let's say, you are planning to do a round, this would be the valuation and so on. Like the other updates about any additions on the team, sales pipeline, those kind of things, that will not be shared with them. Okay. So let's go to the next one. Okay, now other matters. So it's a young company. When you started off with your co-founders, you're raising your first round of capital, like a proper capital round. Then the founders will also be asked to vest their shares. So if you own 50% of the company, let's say, and then you have another who is owning 20% and so on, then whatever shares you are entitled to, you will also have to vest for 4 years. Same thing, 1 year cliff vesting period, because if you're not vesting, maybe you see some other opportunity, you sell your shares and you run away, right? So just to safeguard that, there is a founder vesting. Next, you have a good leaver or bad leaver clause. So this is very European related, good leaver, bad leaver. This is basically that if you leave after some time, what kind of shares would you have from the total ownership which you had? So after 1.5 years, if you're leaving, you're a good leaver, there's something which happened in your life, you can't continue, right? Then you would be entitled to those many shares. But let's say you spend 1.5 years, but you embezzled money, maybe, or you, let's say, took some gross negligence and you are actually aiming to do so. So that's a bad leaver. So the bad leaver provisions will basically state this is the bad leaver clauses. And when a person does something like this, they will not be entitled to any shares or any compensation or so on. So this, again, a way investor is trying to protect the company. No shop agreement. So no shop agreement is a way for an investor to seal a hot deal, where they would state that once you sign the term sheet from us, you can't go to any other investor to get a lead, where you can go and say, hey, I got a term sheet from this VC. Well, if you want to join a party, can you, I'm giving away 20%. What if you, let's say, take only 15%? So if there is a no shop agreement, you can't do that. Now you can, of course, go and solicit co-investors. So you can say, I have a term sheet from a lead investor. And if you would want to join the party, now this is how it is. So no shop agreement applies mostly to shopping for another term sheet with other lead investors, co-investors. Of course, you have to keep your lead investor informed that I'm talking to these people. And at times they will also help you jump on a call and say, here is why we are investing. You should also join the party, mostly. Expiration. So that's where if you don't sign the term sheet for 30 days since the date of issue, then the term sheet expires. Okay, if you have taken no action, that's the simple meaning. Now, expenses is very important. So the equity round will have expenses because there is legal due diligence, and money will be paid to the lead investors counsel, known as the lead counsel. Okay, so for an equity round, it will be legal plus if there is any diligence which has to be done. As a best practice, it will always be capped. That it will say that it's a 2 million round, then the total expenses will be capped at 20K. That's it. 20K is the total amount. So you will end up basically getting 2 million minus 20K. That's something which you have to pay. Of course, there is a debate where some founders say, why should founders pay? The investor should pay out of that, like it's a transaction fee, right? But it's really very hard to negotiate. This is like they usually pass it on. Very few funds actually model their fund with a transaction fee where the founders don't have to pay. Okay. And in between, if you are raising money with a special purpose vehicle, right? So if you have, let's say, 20 investors who want to invest small ticket size, like 5,000 euro, 2,000 euro, 3,000 euro. So you create a legal entity known as a special purpose vehicle. Everyone invests, right? And this special purpose vehicle will have one line in the cap table. So let's say you're offering 10% to 30 people, so it will be 10% on a vehicle, and everyone pro rata to their amount they have invested will have ownership of that special purpose vehicle. So when these special purpose vehicles are also executed, what can happen is that the entity which is helping it execute, like there is a platform called Odin in Europe, which does that. So they will take a small fee as well, 2K, 3K out of, if let's say anything 50K is invested or anything like that. So that will again be paid if the SPV is taking money on top, like a 2% extra, then you get the full amount. If not, then that can be also additional money which you'll be paying. So that's why equity round is kind of like expensive, because you will have these kind of expenses also coming up. So you will not get like the complete full amount, a little bit less than that. So always model for that. Let's go to the next one. Liquidation preference. So this is the part where I said liquidation preference is important to understand. Okay. So as I said, industry standard is 1x non-participating, but in some jurisdictions, you can have 1x participating. In Eastern Europe, I have seen this. Robert, you can also state if you have seen whether it's participation or non-participation, but whenever any investor who's not very seasoned or anticipates super risky, they want to be protected. Simple psychology. If something is scary, you want to make sure that you are protected as much as possible, right? So that's why you will take a participation. Now, what's this? Let's go to the next slide. So let me give you an example to understand this, because that's how you can understand. So let's say a company raises 500,000, giving away 20%. Okay, fully diluted shares was 10 million before this investment takes place. Seed investor has 1x non-participating. So on the left side, you start off with common shares 10 million, 80%, because 20% is given to the seed one investor. Let's call the seed one investor, and that person got 2.5 million shares. So total 12.5 million after that seed round has happened. Okay, so you can see this is all the calculation: 500,000 for 20%, divide that 2.5 million, then pre-money, 500K deducted, and price per share is basically this 2 million divided by 10 million. Okay, 20 cents. So these are your assumptions. Now, on the right-hand side, let's take some exit valuation. Like if the company exits at 1 million, 1.5, 2, 2.5, 2.6, 3 million, 5 million, 10 million. Okay. So if a company right now, after this round, the fully diluted shares is 12.5 million. So let's take 1 million. If it gets sold for 1 million, right, fully diluted shares is 12.5. The selling price is 1 million divided by 12.5 million. So about 8 cents. Okay. Now purchase price was 20 cents PPS. So it's much lower because of course it's like 1 million the company is getting sold and the pre-money was just 2 million, right? So this means now here the seed one investor, their shares was how much? They had 2.5 million shares, which is the number of shares which was allocated to them. Okay. Now they have 1x preference. So how much they had invested? 500K. So their liquidation preference value is 500K, one time the amount they had invested. Okay. So now they can take this 500K and go home. Okay. Or what they can do is don't take the 500K, but convert this 2.5 million preferred shares to common shares. So when they convert, this means that from this 1 million, basically they can take 20% because they converted to common. So 20% of 1 million will be 200K, right? So now the investor has two choices. Should they convert, go home with 200K? Should they not convert and go home with 500K? So obviously the investor wants to go home with 500K at least, right? So they exercise, now they are exercising liquidation preference. They take 500K, they go home. What's remaining? 500K, the founder gets 500K. Okay. So 1.5 million, you can see it, the same thing, 2 million, 2.6. Now let's go to 2.6 million. Okay. So here, as you can see that the sale price is just, 0.21, 21 cents. And here it was 20 cents, right? So this means that if they exercise liquidation preference, they go home with 500K. But if they don't, then they can go home with 520K. Right? So now the investor would say, let me convert. I will not exercise my liquidation preference and I will go home with 520K, right? So 520K will go to the investor and the founder basically gets 2.6 minus 520K, about 2,080,000.
So
And
basically at 2.5, he is at the break-even point. Like whatever he gets over 2.5, he would try to use his liquidation preference and maybe do the normal stock.
Yeah.
And whatever is below 2.5, it is preferred stock, and at 2.5 it does not make any difference if he uses or doesn't. Is that right?
So, so as the valuation will increase, better to convert. Then the
Better to
valuation
convert, yes. So
exercise
2.5 is the breaking point, basically.
Yeah, because that was the post-money valuation at which they came in, right? So this is a
Yes.
very simple. Okay.
Okay.
Now, Robert, let's go to the next slide. What if now the investor had 2x liquidation preference, right? So this means in the same example right now, the liquidation preference value is now 1 million, 2 times 500K. So they will now take the entire 1 million and, conversion value would have been 200K. So this means there is nothing left for the founder, right? Then you go to, let's say, still 2.5 till even to, let's say 2.6 million, because they are winning, they have 2x, right? Only when you start looking at 5 million, that's where, because it's double the valuation, that's where it's equal. So after that, when it's 10 million, then they can say, okay, so if I exercise liquidation preference, it will be 1 million. But if I don't, then I can get 20% of 10 million or 2 million. So let me exercise that. And I go home with 2 million and 8 million is remaining, right? Now here again, the key is liquidation preference multiple has increased, but it is still non-participating. Okay, let's go to the next one. Okay, so in non-participation, the investor basically has either exercise liquidation preference or convert. That's it, that's non-participation. But participation, it's also known as double dipping. So this is where they can exercise liquidation preference, they can also convert. Same time, right? So in this way, the investor will always get more, right? So now let's see how participation in the same example looks. Go to the next slide. Yeah. So a little bit more columns over here. So left side, it's the same thing. 20% is given away and so on. And we have same scenarios, 1 million until 10 million. Okay. So we take the fully diluted shares, selling price, that is your 1 million divided by fully diluted shares. And this is the purchase price. Okay. And this is the number of shares the investor has, the preferred shares. Now here, the liquidation preference value, this is 1x participating. Okay. 1x participating. That will be 500K. Okay. Now, if they are going to convert, they get 200K, right? But here, because the investor is participating, the investor would say, I will utilize my 500K. Okay. So now what the investor does is they take 500K from 1 million. Now 500K is remaining. So now you divide this 500K by 12.5 million, because in the last cases, when liquidation preference was exercised, let's say the shares of the investor were gone, like they said bye-bye. But here, now what's going to happen is that the investor will participate. So whatever that 500K is left, they will also take 20% of that. Okay. And then basically now the investor gets 500K plus this 100K. They are double dipping. So they take the liquidation preference, whatever is left, they again take 20% of that, right? And then they are coming out with 600K. So founder is getting even less here. So in our first scenario, if it was 1x participating, the founder would have gone home with 500K. But because now the investor is double dipping, subsequently their returns are increasing on the same exit valuations. So this is why they would be double dipping. They will always take the liquidation preference because they know I'm also going to take another portion. Whatever will be left, I will take 20% of that, whatever is my pro rata ownership. Okay. So now let's take another example in the same participation. Let's go to the next one. So now if it was 2x, so here, of course, well, the first one, 1 million takes 1 million, nothing is left, right? But here, if it's 1 million, 300K is left, they will take some portion of that too. And then they will end up coming at 1.1 million. So if there is participation, higher multiple, there are cases where the founder will end up getting maybe nothing. So liquidation preference, that's why the higher the multiple and participation, and imagine, this is what I'm showing you with just one seed investor. Let's say you had Series A, Series B, Series C, and everyone had higher. Even if you exit at like 700 million, maybe the founders would end up getting zero. So that's why liquidation preference can really kill you if you have a higher liquidation preference and participation or non-participation. Okay. Let's go to the next one. So this is basically, we are looking at participating versus non-participating. So from the same examples, I have just cut one portion of when you look at these different exit valuation. You look at non-participating, you look at participating. You see, in participating, it's always better. 500K, 700K, 500K, 800K, 500K, 900K. Here it's 2 million, which is like the max here for 10. Here it's 2.4 because of the double dipping. Okay, so this was on 1x, and we can go to the next one, which will be on 2x. Yeah, so it's the same. Okay, let's go to the next one. Okay, let's go to the due diligence section now.
Maybe Gautam, I don't know. I'm just trying to imagine after a long week, if you still have energy, because we have only 15 minutes.
15 minutes.
We can use these minutes in order to kind of wrap up what we discussed today. And Gautam, maybe you can keep the due diligence and data room and some key metrics for the negotiations with investors, because it's somehow related with the negotiation. Or if you still have energy, then we can spend the next 15 minutes on
15 minutes on that.
As you wish. It's an open discussion. We will discuss about this at the next workshop, or we can discuss now for the next 15 minutes.
I was just to make a wrap up, the summary of the past 2.5 hours more.
Okay, I agree with
Yeah, for me to wrap up would be great.
Okay,
So
let's wrap up discussion. We know that there is a lot of information, and we didn't say you, but we had another 50 slides for this presentation. So yeah, it was a long presentation, and we imagined before that probably at the middle of the road we will say it's enough. But take your time, read the presentation, find out all the terms on the internet, try to discuss with lawyers when you have the opportunity, try to make some scenarios, and maybe we can take a real example for you guys. I mean, you are at the pre-seed stage, so most probably you'll be having kind of an angel investor or an angel network, or in this range or a crowdfunding platform that would be your first partner, your first investor. And then let's take it as an example from my experience, and then Gautam, you can continue. For the angel investors, there wouldn't be so many terms. Usually they rather prefer to use a CLA, convertible loan agreement, with a few terms. Or in my case, I did an investment via Seedblink, which is a crowdfunding platform, and they basically did all the due diligence and everything behind it, and I was just an angel on the crowdfunding platform. So what I believe it's important for you is to know that even though there are a lot of terms in here, not all of them will be used in the first years for you, but it's good to have a flavor of what is happening in the ecosystem, to try to understand what would be your journey for the next 5 to 7 years, because it's good to have this kind of vision and say, okay, even though I'll be starting with an angel, in 2 years I'll have a VC and then another VC, and you need to know a bit about this, the fundraising process. Gautam, if you can give some example from your experience at pre-seed stage, what would be relevant regarding to the investment terms, then we can try to wrap up and try to answer to some questions.
So another objective which we had with these sessions is that we want to set you up for the future as well. So that's why we discussed all of these terms, which might not be as relevant for you now in this stage, but that's going to help you later on. So you don't get caught up like, oh, I didn't know what this is, right? So that's why with the length, we were actually encapsulating so many different concepts. But what's usually going to happen for a lot of you guys is that you will go after a lot of these super early stage investors, angel syndicates, for example, group of angels. Equity crowdfunding will be one. If you can do just product crowdfunding, get a lot of customers and you can get customer contracts, that's going to be very helpful. And perhaps some of you will get grants, non-dilutive grants. That's also another way where you can bolster the operations of your company and start growing it. And perhaps very small micro VC funds, who invest 20, 30K, something like that. Or you can be part of any accelerator. Like I think Startup Wise Guys is one of them, and some other accelerators and so on. Now, what's going to be helpful is that if you become part of something like Startup Wise Guys, they have a term sheet. Okay, they will have a convertible security where they are going to convert. So that's going to be same like a convertible security. So you have to know how to read it. They will have different conditions on conversion, and at times it can be counterintuitive in the sense that they will end up getting more of your company in case that things are going well. So I will not name a company, but some of the Rubik's companies had consulted me where they received term sheets. Does this look good? Does this not look good? And they were confused about a lot of the terms which I have discussed right now in this one. So they had to get to know a lot of this even at a pre-seed stage. This is like the first stage of investment which they are raising, right? So dealing with people, again, remember that business is one aspect, but the people aspect is going to make a very big difference right now. And for anyone who's very active, remember, they are seeing many companies. Someone can be similar to yours. But if your relationships get built up better, then it can increase the chances of you getting investments as well. So that's what I would say, that, I threw in a lot of big numbers here and there. Now I can do that with smaller numbers as well. But it's, again, just to give you guys some ideas of how this actually plays out. You can just divide everything by 10 and you get in all examples small numbers.
I also remember a quote that I heard to an investor probably 1 year ago, which is somehow related to this discussion that we're having, which says that cash is the king, but growth is the queen. So basically, you should rather focus on, growing your company more than, focusing on securing your investment. Because if you don't have a clear vision, a clear go-to-market strategy, a clear pathway towards being a great company, then probably the investor wouldn't be, impressed by what you are building. Yeah, I'm trying to give you some real examples that might be helpful for you. But I believe that, as Gautam stated for this session, we try to give you some insights regarding the investment landscape, try to better understand some numbers. We will send you afterwards, I will send you a document, an Excel with valuation methods, so you can try to play a bit with those numbers, try to figure out a bit what would be your valuation according to those methods. Gautam, you'll be sending the CLA, so basically you can play also with the numbers to see how your cap table can move in a way and try to better understand. So you can make these exercises for the next time, for the coaching session. Anyway, we are here if you have further questions, or if you would like to discuss more about the topic that we are not able to discuss today, or keep it from the coaching session.
Thank you, guys.
Thank
Bye
you,
bye.
guys. Bye.